The inflation problem is not going away. That will continue to create more and more risk of financial stability issues down the road.
I do see risks building that, could perhaps jeopardize this smooth disinflation.
Basically, every single investor pricing in a soft landing, which again gets me quite nervous.
All we need is a tiny whiff of less dovish data, and it, I think, would already be enough to send a bit of pain across all the asset classes.
If we were to get an upside surprise on CPI, then folks might say, wait a second, is this thing really overheating?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is CPI Tuesday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market inching lower. We're negative by 0.4% on the S&P 500. Typically, we start this program by talking about inflation, but you don't want to miss the Bramo run on schools in New York City. Mayor Adams, Eric Adams, saying we're strongly encouraging New Yorkers, if you don't have to go out, stay home. Stay safe, New Yorkers. We're looking for up to 8 inches of snow dumped on New York City this morning. In the tri-state area, it is wet and windy. Parts of New Jersey, Pennsylvania could see as much as 12 inches. Public schools in New York City.
How long are you going to do this for?
I'm going to keep on going.
Keep going.
They're closed, apparently. Remote learning.
Yes.
Bramo, thoughts?
I just, honestly, it's like adding insult to injury. As a parent, first of all, having your kids home is a pain in the neck because you have to figure out where you're going to put them, how you're going to deal with them, what is going to be the opportunities for the day, for getting outside, etc. But then to have to oversee them and they're learning and get on their case for not doing their homework assignments while they're looking out the window, hoping to go sledding and feeling caged in and arguing with each other. It's just too much.
When you were told yesterday evening, as far as they're concerned, do they believe it's a snow day or do they think they have to learn something today?
They think that they've got 10 minutes of logging on, taking attendance, and then they can go outside. I assume that they also have work that they have to get done. And I assume that as the parent, I'm supposed to oversee it. I just think either you give a snow day or you don't. This sort of half-half makes it just more of a burden for the parents.
We can recap both Lisa's thoughts throughout the programme and get you real updates from Danny Berger every 15 minutes, every 30 minutes on this show. We'll catch up with Danny a little bit later this morning to get you all an update. Stay safe out there, of course, if you are commuting this morning. Let's turn to the inflation data. CPI numbers, this is what we're looking for. We are looking for a two-handle on CPI year over year. On the headline read, 2.9% is the estimate, 3.4% is the previous read. Strip out food and energy, we're looking for something at least closer to 4%.
Yeah, and basically what you're looking at is year over year going in below 3% for the first time going back to 2021. Here's what I'm watching. The actual components. The broadening out, because that seems to be the key phrase for a lot of Fed officials, whether it's Barkin or whether it's Boston Fed President Susan Collins. But the idea here is it just products? Is it just food and energy? Or is there something further under the hood that can give the Fed confidence?
And what is the risk that we stabilise north of the 2% inflation target of the Federal Reserve? That number drops at 8:30 Eastern time. And then the political spin is going to begin. And I would argue the political spin already started right before the Super Bowl when the president released a video. Annmarie talking about shrinkflation.
The president released a video from his campaign account. The White House released a video. And yesterday, the president, at a speaking engagement, went after corporations yet again, calling it greedflation and shrinkflation. He's not mentioning brands by names, although he did recently mention Snickers, which the president was actually wrong, and the fact that the Snickers bar did not shrink. But this is a way that the White House is likely going to try to massage this message. But every time we do get in the CPI report, he does come out and says more work needs to be done, although Treasury Secretary Janet Yellen seems to want to call victory on this soft landing.
This is the standard of the conversation, Lisa, down in Washington, D.C.
What, they were talking about Snickers bars?
Basically.
I mean, and then on one hand, we're talking about how the Snickers bars aren't big enough. On the other hand, we're talking about how to get Ozempic shots. I mean, put it all together. But here's the question. Ultimately, how do you message something that is good progress, but people still feeling the 2-year cumulative inflation? It's going to be tricky. The key is to talk about where progress needs to happen and talk about it in a granularity and treat people like they're smart and they actually understand what they're talking about.
Just a note on policy and not politics. There is a bill working its way through the Senate, believe it or not, at 6 a.m. in the morning down in Washington, D.C. You told me a little bit earlier this morning they've turned up in gym clothes.
Some of them. Not
everyone. On Capitol Hill, apparently, to try and pass this foreign aid bill.
Well, some of them are being woken up to get back to the Senate floor to vote on this, and it looks like they have the numbers, but the vote is still open at the moment. They will be passing $95 billion in the Senate for Israel, Taiwan, and, of course, Ukraine. The issue is, last night, Before I went to bed, the last thing I read was Speaker Johnson, a statement from him saying basically this isn't going to happen in the House. In the absence of having received any single border policy change from the Senate, the House will have to continue to work on its own will on these important matters.
So I rant about schools and you rant about what these senators wear. You're the sartorial critic of the Senate.
I was just curious. That's all. This is what AMH told me. It was the first thing Anne-Marie told me a little bit earlier this morning. I think it's disrespectful to the office. No, it doesn't matter. Equity futures on the S&P 500 look like this. We're negative by 0.4%. In the bond market going into CPI a little bit later this morning. Down about a basis point, 416.96 on a US 10-year. Coming up this hour, Chris Ferro of Strategas with stocks a little softer ahead of today's CPI report. Norman Rule, former senior US intelligence official, as Biden calls for a 6-week pause in the Israel-Hamas war. And Jennifer Lee of BMO as investors look for an inflation read below 3%. We begin with our top story, the equity rally cooling ahead of this morning's CPI print. Chris Ferro of Strategas saying even if we get a pullback in equities, the floor is high. Writing, quote, if the market is to consolidate, expect it to be contained. Trends remain overwhelmingly positive for a 50-day support on the S&P 500 at roughly 4770 and longer-term worst-case 4600. Chris Ferro of Strategas, a bed company, joins us now for more. Chris, it's great to catch up. We got the Bank of America Fund Manager Survey a little bit early this morning. I'm going to go through the most crowded trades for you. Long Magnificent 7, 61% of respondents. Short China, long Japan, long cash. Long cash, by the way, is only 2%. But overwhelmingly long the Mag 7. Chris, when you look at things, how one-sided, how concentrated are some of the action that you've seen over the last month or so?
Well, I think it's certainly one-sided in terms of the leadership, but this idea that it's just 7 stocks working in its entire market, I think is a little misleading. I mean, you have the small caps breaking out right now. You have the equal weight S&P making 2-year highs. Now, I recognize these things have not been leadership, but really what has? It's been a very high bar to outperform the top of the market. But the good news is the other stuff, the other 490 stocks, the equal weight, the small caps, they aren't going down in price. So when you look at the health of the market, I think you still have to argue it's pretty broad. It's well participated here. You could certainly get some type of a seasonal or sentiment-induced pullback here. But as we wrote yesterday to clients, I think maybe 4,600, 4,650 would be kind of worst case in terms of any seasonal weakness here.
Chris, when we spoke to you closer to the start of the year, you were talking up financials and the performance of financials coming into 2024. What's the state of play now after that, I would say, speed bump, sort of hiccup with NYCB just a few weeks ago?
You know, it's remarkable, John, how quickly people want to kind of go back to the imagery of last February, last March, when the regional banking issues were first starting to percolate. I think it looks different this time around. Very importantly, as the banks and the regionals have sold off here the last couple of weeks, what you haven't seen at all is any stress in financial credit. That's a very big difference from a year ago when you began to see stress really permeate through the financial system, through the avenue of credit. I think the other thing you haven't seen here, unlike last year, when the regionals came under some pressure, you began to see this very persistent bid for the market's more defensive corners. You saw it with staples, you saw it with utilities, and you don't have that here either. So if I'm going to evaluate kind of the correction that we've seen in the regionals or the real estate names or the banks here over the last 3 or 4 weeks, I actually look to it as quite viable. The trends are pretty positive under the surface. I think at a minimum, let's give them a little leash here to respond to this oversold condition.
So buying regionals or buying financials, just to be clear?
Both. I think we'll get some, I mean, and yesterday was a great example for some softness at the top of the market with the tech reversals. You actually saw regionals and banks in particular act very well off support. I think you'll get a very good oversold response here from those what I think the consensus would say are the questionable parts of the market, the regionals, the REITs. And when you look at the banks more broadly, keep in mind the capital market stocks continue to act well. Goldman Sachs made a new high yesterday. The consumer finance names continue to trade well. That's American Express and Capital One and Ally Financial. What's often perceived as one of the weaker parts of financials actually trade quite well here.
So at this point, there's sort of a test. How far bullish are people right now? To have a downside that isn't that down is fairly bullish, but then the upside being driven by small caps is next level. And I'm wondering, you're talking about how the consolidation we've seen is basically a far cry from some of the gloom and doom that people talk about. Is it enough to get in and to bet on the broadening out that has yet to happen?
Well, I think this story that the broadening out is yet to happen, frankly, Lisa, is a little misleading. I mean, we're only 6 weeks removed from some of the best breadth readings we've ever seen in 50, 60, 70 years worth of data. It was December 14th. You had more small cap stocks make a new high than you've seen in basically since the inception of the Russell 2000. And their only crime they've committed in the ensuing 6 weeks is simply consolidating that move. So I think this idea that, the broadening never happened is a little bit misleading here. I think it began to happen in the fourth quarter. We've paused here, but all signs point to this re-engaging here. I thought yesterday was really interesting. The S&P finished lower, but you actually had more stocks up on a percentage basis yesterday than the highest reading we've had all year. So internally, yesterday looked good. You had the banks respond. You had the small cap start to break out. So let's give this a little bit more leash to kind of re-expand here.
Chris, you know why? It's because the excitement is elsewhere. We're looking at stocks like ARM, which have basically doubled in 3 days and tripled since the IPO. Nvidia's absolutely flying again, going into earnings next week. I want to talk about the consumer, Chris, with you just briefly. So we've got CPI a little bit later this morning. In a couple of days, we've got retail sales as well. When you look at staples versus discretionary, what's the signal you take from the performance at the moment?
Yeah, it's a great question, John. And, we always say we'll take the market's intuition over our own any day of the week. I think the market's the best economist that I know. And the discretionary versus staples pair is a very good barometer for how the market perceives the economy. And that made new highs yesterday. And so did transport versus utilities. And so did high beta versus low beta. So all the, let's call them risk barometers that I would look at to gauge how the market perceives the economy are still in pretty good shape. And I think interestingly, you mentioned some of the stories going on abroad. I mean, you have a lot of new highs going on abroad too. You have Taiwan at new highs, you have Korea breaking out, you have German DAX and French CAC right there as well. And I think very importantly, you have the signs or maybe the early signs of some capitulation in China right now, which is interesting to us.
Most unloved equity market in the world, Chris. Do you like it enough?
Yeah, I thought peruse the FT, the New York Times, and the Wall Street Journal from the last 2 weeks. You can't find a bullish word written on that part of the world. You had 80% of the Shanghai Composite make a 52-week low last Monday, except the worst parts, financials and property stocks. Something there is changing. I think it's changing right now. I would cover your shorts. I'd look at the price action in the domestic equity market, look at the breakout in WIN, in LVS, and MGM, look at the turn in Yum China. Something's happening there, and I think at a minimum, the bears have to cover shorts.
Interesting. Chris, good to hear from you. Chris Ferrone,
thank you.
A strategist on the most loved equity market on the planet right now. I'll go back over the fund manager survey from Bank of America. Bramo, I know you read the same thing. We're looking at the most crowded trades. Long Magnificent 7, that's the number one most crowded trade. Number 2, short Chinese equities. Right to his point.
And to Damian Sassauer's point, is it a trade? Maybe not an investment, but a trade. Something's happening there. I love that statement. Something's happening. Take a look at MGM. It's kind of, you see the sort of returns picking up just a touch. It shows, though, just how risk-on people are, that they're willing to say, well, the technicals are so bad, it can't get any worse. I guess we're going to, throw a few dollars into that area.
It's the one place where sentiment is really rock bottom. And down B. Equity futures on the S&P, by the way, we're negative here. Near session lows, we're down about 0.4%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. New York City residents are being urged to stay home today. The city is forecast to receive up to 8 inches of snow. Mayor Eric Adams closed public schools and moved students to remote learning. Snowfall of more than the 7.3 inches in Central Park. It'd be the most since Jan 2022. Areas north and west of the city could get as much as a foot. Northern New Jersey, eastern Pennsylvania, and southern New England could see as much as 12 inches today. Former President Donald Trump has endorsed his daughter-in-law to help lead the Republican National Committee. Former television producer Laura Trump is married to his son Eric. Under the plan, she would become co-chair with the RNC's general counsel, Michael Whatley. The move would tighten Trump's grip on the party. According to sources, current chairwoman Ronna McDaniel is in discussions to step down. And Sunday's Super Bowl was one for the history books, a first back-to-back win for a team in 19 years, plus the most TV viewers ever. CBS says that 123 million people tuned in to watch the Kansas City Chiefs defeat the San Francisco 49ers in Super Bowl 58. That's a 7% increase from the previous high, which was set last year. Betting also set a record, with gamblers in Nevada wagering a record $185 million on the game. That's up 21% on last year. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Bramo, surprised? Not really, right?
About the record? No, I think we all were expecting it. It basically is up from, what, 113 mil last year?
Yeah, about 115, something like that.
Yeah.
Taylor Swift effect, is that what we're saying?
I guess.
No.
Do you really want to talk about her again?
Not really.
Okay.
I want to talk about Jim Nance.
Oh, sure.
I want to talk about Jim Nance and CBS Sports because that guy, absolute legend. I tune in for Jim Nance of CBS Sports.
You're talking golf?
He does golf as well.
Yeah.
Yeah.
You want to talk about
does
golf?
all sports, Bramo.
You're basically saying, let's shift gears from the Super Bowl
to golf.
and talk about golf.
No, let's not. Up next on this programme, President Biden pushing for a pause in Gaza.
The United States is working on a hostage deal between Israel and Hamas, which would bring an immediate and sustained period of calm to Gaza for at least 6 weeks.
That conversation is coming up next, live from New York City. This is Bloomberg. CPI data coming up a little bit later this morning. Equity futures on the S&P just a little bit softer. We're negative here by a third of 1% on the S&P 500. Down a single basis point in the bond market, the 10-year, 416.37. Under surveillance this morning, President Biden pushing for a pause in Gaza.
As the King and I discussed today, the United States is working on a hostage deal between Israel and Hamas, which would bring an immediate and sustained period of calm to Gaza for at least 6 weeks, which we could then take the time to build something more enduring.
Here's the latest this morning. President Biden pushing for a 6-week pause in fighting between Israel and Hamas. The president speaking alongside King Abdullah of Jordan. The meeting coming amid growing concern about a potential Israeli ground offensive in the city of Rafah, where over 1 million Palestinians have fled since the war broke out. King Abdullah calling for an end to the war, saying this: "We cannot afford an Israeli attack on Rafah. It is certain to produce another humanitarian catastrophe. We need a lasting ceasefire. We need one right now." Joining us now is Norman Rule, former US intelligence official and a member of the CSIS Transnational Threats Project. Norman, can we just take a step back and think about the original objective of the Israeli military, which was to destroy Hamas? How much progress have they made in the last several months?
Good morning. Without diminishing the significant humanitarian catastrophe of Gaza, Israel has achieved significant success against Hamas. In essence, Hamas had 5 brigades arrayed from north to south. 2 in the north have been destroyed. 2 in the center have been significantly degraded and are in the process of being destroyed. And the final brigade is located in Rafah. But as they have moved south, the nature of the battle itself has changed because of the concentration of civilians, which is why the United States was pushing for a less intense conflict and more hyper-focused surgical operations against the remaining Hamas leadership and fighters.
Norman, how does Israel go into Rafah to get rid of the remainder of Hamas and at the same time make sure that they are credibly making sure that they are protecting Palestinian civilians?
Well, they only have 2 choices. First, they undertake a very long campaign to degrade both the Hamas remaining brigade, but also to go against the tunnels under Rafah. And these are extremely deep, and this is where the fighters are hiding. This would be a very long and costly battle while the civilians are suffering. The alternative is to move the civilians out. The problem is there's not many places to go. They could go to El Mawasa, about 6 miles away, too small. They could send them north again, not a lot of facilities for them in that area. They could move some into Khan Yunis, where fighting remains, or they can work around them. It's very complicated.
You have the head of Mossad today meeting with CIA Director Bill Burns. If they are able to move ahead with a hostage agreement, would that mean that Israel would then not go into Rafah?
Well, Israel would say that a hostage agreement would delay going into Rafah. Hamas will push for a very lengthy hostage agreement that in essence would allow them to survive and declare victory through survival. If you're Hamas, survival means victory and then dominating the post-war environment and in essence restoring Hamas's domination of Gaza and perhaps the West Bank.
Norman, how much are you concerned about Netanyahu, the prime minister of Israel, and how much the news reports seem to suggest he's going it alone and kind of defying a lot of Biden and what he's saying? Does that give you pause?
Well, it's a concern, but I think Prime Minister Netanyahu also does reflect a genuine belief in Israel that they cannot sustain another situation where Hamas might return and repeat what it did on October 7th. So it's fair to say that Prime Minister Netanyahu reflects a hard line of the right wing, but it would be unfair to say that he's the only person that believes that Hamas must be destroyed, that a new situation in Gaza must develop, and that a two-state solution should not be rushed into, because that might just mean a Hamas-dominated entity on the Israeli border.
Norm, I have to say, there are senators in the pajamas right now voting on this bill, trying to get aid to Ukraine and to Israel passed. It's dead in the water because the House isn't going to bring it. And you have Elon Musk talking to U.S. Republican senators yesterday saying there's no way in hell that Russian President Vladimir Putin could lose this war in Ukraine. We got to kill this thing. That is Vance, when we're talking about the potential bill. What do you make of that? How concerning is that?
It's concerning. In essence, it may be politically popular to deny aid to either party, but in the end of the day, providing precision-guided munitions and strong intelligence protects civilians and enables those partners that we support to win or sustain their defense. It's as simple as that. If you deny them precision-guided munitions and intelligence, you lengthen the fight, increase civilian casualties, and you certainly don't necessarily undermine their will to fight.
Norman, let's talk about U.S. rhetoric and U.S. policy. U.S. rhetoric is shifting. Private meetings reportedly suggesting the president, Joe Biden, is calling the Israeli leader an a-hole 3 times separately. That's a shift in rhetoric and maybe a convenient leak from this White House. Norman, have you seen a change in policy in any way, shape or form?
Practically no at present. The U.S. aid continues to flow forward. The cooperation on hostages continues to be strong, but the U.S. is appropriately concerned over how the Rafah campaign will go. There is nowhere to move this population. If Israel conducts a traditional campaign in the south, the civilian casualties would be enormous, with catastrophic humanitarian consequences, but also huge political consequences in the United States, and obviously a domestic political component as well. I don't think Israel intends to do that, but nonetheless, I think the concern in the White House is indeed genuine.
Norman, sometimes it's quiet with regards to regional actors, and I'm thinking specifically of Saudi Arabia. What are you anticipating is going to happen with them in the coming months, coming quarters, towards the end of the year? Are you expecting a shift in their approach to this situation?
I do not. The Saudis are going to consistently call for a ceasefire, a two-state solution with a definite time frame for when that solution must come about, and a situation where the humanitarian aspect of Gaza is resolved. There is enormous sensitivity in the Arab world to what they see as the daily drumbeat of the death of Palestinian men, women, and children. We don't have that same drumbeat in the West, and the Saudis aren't going to shift.
Norman Rule, thank you, Norman. It's got to catch up. Former senior U.S. intelligence official as the President of the United States pushes for a 6-week pause. Can we talk about angry Biden and how convenient some of those leaks might be? Do you think that is more about him being questioned about his mental acuity, how focused he is on the job at the moment, that ultimately they want to see him as being focused and angry, passionate behind the scenes?
Well, Biden is very well known to have a temper. This has been documented to his time when he was vice president. But these leaks are coming from individuals in the room, according to this NBC report, who were at donor meetings. And Karine Jean-Pierre was asked about this yesterday, and she said she's not going to talk about or elaborate in the president's private conversations. But clearly, there is a lot of frustration in the White House, but also within the campaign. You see an outreach from this administration to go to places like Michigan, where there's groups saying, quote, abandon Biden, that voted for him in 2020, Muslim Americans, and feel like he's turned their back on him.
As Norman said, it's a change in rhetoric, but not a change in policy. Coming up on this programme, the demand for AI helping chip designer ARM to nearly double in 3 days. That conversation is coming up next. Live from New York City, this is Bloomberg. Live from New York City, CPI report about 2 hours away. Going into it, the scores look like this on the S&P 500. Negative here by a third of 1%. On the Nasdaq, down by 0.6. Pulling back just a touch yesterday on the S&P, snapping a 4-day winning streak after 5 weeks of gains. The last time we had a weekly loss was the first week of this year, and then you've got to go all the way back to the end of October. That's how good things have been over the last 3 months or so. Your equity market then pulling back. The bond market looks like this. A 2-year, 10-year, 30-year shaping up as follows. The 10-year yield down by 2 basis points, 4.1618. The 2-year down almost a single basis point at 4.4677. Quick look at the euro. Was negative yesterday, just a little bit lower, and it's bouncing back today. 107.81. We're positive on that currency pair by 0.1%. Under surveillance this morning, US CPI data on deck 2 hours from now. Bloomberg survey forecasting an annual read of 2.9%. This would be the first read below 3% since March of 2021. Bloomberg Economics also expecting housing, rents and core services to overtake core goods as the driver of disinflation. This conversation picked up around this table, I think, in the last week or so, when we heard from Mr. Barkin of the Richmond Fed, and he talked about the B word, Lisa. We need to see this broaden out.
I'm hopeful, but still looking for more conviction of the slowing inflation, that it is broadening and sustainable. Those were his words. How much do you end up seeing this in that data? What people are saying, it suggests that we will. If you don't, is that going to be enough to keep the Fed on hold? If we do see it broaden out materially, but the headline number doesn't shift, is that enough for them to cut in March? Is that where our conversation and our threshold is going?
And does this have the potential to tip us into maybe a less favourable market regime? To those of you that are constructive on equity markets, I'll go back to that quote from Stuart Kaiser of Citi yesterday around this table. This print, quote, has the power to toggle the storyline between soft landing and overheating.
What I find interesting is after he came on our show and after he put out that report, Citigroup analysts came out and warned of a possible 1998 situation where the Fed does cut rates a couple times, but then is forced to raise them again in a year or 2 years when inflation heats up again. How much is Stu talking about exactly that type of environment where basically it's just you don't kill the beast, it kind of lingers there, and you end up in a very different regime than zero rates that we had for so many years?
Without a doubt, that's the scenario that some of these Fed officials are clearly fearing. Want to keep one eye on this down in Washington, D.C. The U.S. Senate voting right now in order to pass a standalone aid package for Ukraine and Israel. Leadership on both sides of the aisle confident the $95 billion will pass today. Speaker Mike Johnson warning it will face opposition in the House without a deal on U.S. border security, saying, quote, the House will have to continue to work on its own, will on these important matters. AMH, this one's going to fail in the House, right?
Yes, it's absolutely going to fail in the House at the moment. Speaker Johnson already throwing cold water on it before the Senate even went to the floor this morning. That vote started at 5:15 a.m. to take up this bill. He threw cold water on it and said it's pretty much dead on arrival. Yet again, he said this in the House. I'm looking at the vote count now. Senator Cassidy, wake up if you're not there, apparently has not voted, according to C-SPAN. It's 69-29, so we're missing 2 senators to vote, but they have the votes for this to go through. But again, it doesn't matter if it passes the Senate because it's not going to pass the House.
So we shouldn't be talking about it, basically?
Well, we're going to have to keep talking about it because at some point, potentially, there could be different avenues or paths forwards for some of this aid. We do know there's a lot of bipartisan support overall for a lot of these programs. It's just potentially how it gets done. Do we potentially decouple them? And there's a separate Israel package, a separate Ukraine package, a separate Taiwan package.
What do you have if you have like the likes of J.D. Vance of Ohio saying things like, we got to kill this thing? And basically Elon Musk saying that Vladimir Putin can't lose. What does that say to our basically allies out there, let alone internally? It just raises this question, regardless of the politics, the theater, a question of alliances, a question of just conviction that the U.S. is going to be there in the same kind of way.
Why do we give people who are successful in a very narrow field a voice on everything, on literally everything? So if you become highly successful in technology or whatever that business line might be, why do we as journalists, and I say we because it's an institutional approach to the news, why do we give them so much oxygen to basically pontificate on everything under the sun?
Okay, fair point. However, Elon Musk was also talking to U.S. Republican Congress members.
No, in this situation,
but I agree with
sure.
you. I agree with you that in some ways the business leaders have become ambassadors, in part because a lot of politicians haven't been as much and that aren't necessarily representing the business world in the same kind of way as they have traditionally.
Also, if Elon Musk was around this table, he would tell you he's done more for Ukraine than almost Europe or the United States, given what he's done with Starlink and the internet connection in Ukraine. But to your point, Jonathan, he has his own social media platform. He decided to corral a bunch of Republicans who are against this bill and siding with him, and we wrote it up.
That's the latest on Washington. Chip designer ARM soaring on Monday, tripling since its IPO last September, and nearly doubling in 3 days. The AI boom also helping Nvidia, which briefly overtook the market value of Amazon during yesterday's trading before settling just shy of a value of $1.79 trillion. Investors going all in on US tech stocks. A global survey by Bank of America saying allocation to tech is now the highest since August of 2020. Bloomberg's Alex Webb joins us now for more. Alex, would you describe this as an AI frenzy, given what's happening in names like ARM at the moment?
Yeah, I mean, it certainly looks that way, particularly with ARM. I think when ARM first came public, it had been trying to convince the market that, it's an AI stock, and there was a certain amount of skepticism about whether that was really the case. It didn't really look as though it was delivering much value at that stage when it came to AI. It seems now that the market is buying that message, certainly given some of the statements made last week. It doesn't have necessarily this kind of direct exposure that Nvidia might have, but a lot of its chipset designs essentially are used to kind of underpin a lot of the specialist chips that are produced by the likes of Nvidia.
Alex, you have the really unwanted job, probably, or maybe wanted by some, of trying to label what's real and what's fake, what's sort of overhyped and what actually has legs. Is the mere suggestion of an AI boost to sales enough to justify the rally that we've seen in the ARM shares?
I'd love to pick, the sort of investor relations and CFO and finance team of ARM's brain right now, because, of course, they want to get the recognition for what they're doing in AI. They don't want to have it over-egged, because if the expectations are set too high, the risk is that you set yourself up for a bit of a fall if there's any sign of disappointment in the quarters to come. If you're an investor, clearly you're not upset if the stock's going high. But I've spoken to other companies who, not ARM, but I've spoken to other companies who express this sort of sentiment, that yes, they want to be recognized for what they're doing, they don't want it to be overcooked. If you look at Nvidia, it's pretty interesting. Like, it's trading at about 35 times its forward earnings. That isn't wildly outside the realms of what some of its peers are doing. The risk is with ARM is actually it starts to get a little bit out of that space. Maybe they can deliver. It is not for me to predict that, but that would be the concern.
Can we officially say that Tesla is out as we see some of these shares surge? And Tesla, I think, year to date is down some 24%.
In terms of AI, I mean,
yes.
It's fascinating when you come look at Tesla, because Elon Musk is trying to make the case that, they're an AI company, and clearly they have a lot of tech at that company. But, I've followed this self-driving space for quite some time, and you never really heard about Tesla being really right up there in the top tier of self-driving technologies. When you think about Waymo, you think about GM's Cruise unit, which has some other investors in it as well. Aurora, those guys really thought of as the top tier. Tesla, not often thought of in the same category. So I'm not sure. Maybe the market is, waking up to that now. Full self-driving is not full self-driving, right? What they brand as full self-driving does not let you go out on the roads with your hands off the steering wheel for an extended spell. So it seems as though that message might now be trickling through, and of course, it only really scales within Tesla. It doesn't necessarily scale outside of that.
Alex, the reason why I ask is because when you zoom out, there's a real question of when the AI boom and craze will sort of trickle out to other companies that are going to use it to create operational efficiencies. This is something that increasingly investors are looking at. Can we see the same kind of boost to equity valuations, the same kind of boost to earnings for other companies outside the traditional tech sphere already coming to the fore? I mean, are people sniffing that out already, or is that still kind of a yet to be discovered space?
In honesty, I don't know, is the answer to that question. There might be companies actually that are going to be very well positioned and will wake up to that in a few years' time. There is a lot of, if you think about some of these big consultancy firms, for instance, they really like to talk about the potential, the likes of Accenture and Young, BCG, McKinsey, all those guys. They really like to talk about the potential of AI on two fronts, right? It can do some of the work that actually they have sort of junior consultants doing right now, and also then they can bring those capabilities into AI fuel capabilities into their clients' firms. Does that mean that they are an AI play? I wouldn't say so. And in fact, Accenture's, I think, the only one that's actually publicly traded. So it's not a great opportunity for investors in that sense. This is still so early, right? This is still so early in the AI revolution, evolution. I think evolution might be more appropriate as a word, because the thing we're seeing right now is relatively broad brush stuff where you see huge applications, the likes of ChatGPT. Increasingly, you're going to get hyper-specialized applications of AI, and that's where the real opportunities are going to explode. We don't really know who those companies are yet.
Alex, good to hear from you. Alex Webb at Bloomberg out of London. Just a quick sneak peek of what's happening in the pre-market with ARM at the moment. After almost doubling in 3 sessions, we're negative here by 2.56% in the pre-market on ARM Holdings. We've been talking about that $95 billion bill going through the Senate right now. Senators up early to pass a $95 billion aid bill for Ukraine, Israel and Taiwan. This is the Senate. Ultimately, AMH, as you said all morning, this is not going to get through the House.
Major hurdles to get through the House of Representatives. And you see Senator Chuck Schumer there talking to a very early morning group of senators voting on this. It came in 70-29. There was a number of Republicans that were in favor of this, bucking against some of the trends we have seen from some of those other Republicans who are following in the former President Donald Trump's lead at the moment, talking about a more isolationist approach. But you have to think, before these senators even woke up and voted on this final passage, they were met with a statement from Speaker Johnson basically saying the House is going to go in its own way.
Do you want to take that live shot again? What did you notice about Senate Majority Leader Chuck Schumer? Suit, tie, ready to go.
I have an update, though, on what they're wearing, though. Steve Dennis told me Senator Britt appeared to be heading to the gym next. Senator Fetterman, trademark hoodie and shorts. Chuck Grassley, farmer casuals, and Ted Cruz wearing a Longhorns sweatshirt.
Great that they're going to go work out. Be healthy. Live long.
Go get them. OK, let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden is forming a task force to address the mishandling of classified documents during presidential transitions. A special counsel report had found that Biden kept documents in his possession after he was vice president. White House officials called it a systematic issue affecting both parties. The task force will provide recommendations before the next presidential transition. The International Energy Agency expects global oil markets to remain comfortable this year. New supplies will satisfy demand and keep prices in check.
In the absence of major geopolitical turmoil or major extreme weather events, we would expect rather a comfortable oil market and comfortable moderate price evolution throughout 2024.
The IEA says world consumption will increase by up to 1.3 million barrels a day, a significantly weaker pace than last year. Tiger Woods is launching a new brand after ending his long-term endorsement deal with Nike. The golfer signed a deal with TaylorMade Golf. Together, they'll create an apparel line called Sunday Red. It's set to debut in May. Financial terms for the deal haven't been disclosed. That's your Bloomberg brief. John.
Danny, thanks for that. Coming up on the program, up next, inflation data on deck.
I think at some point it will be appropriate for us to lower the federal funds rate. I don't see that in the immediate future, and I don't want to prejudge what our decisions might be going forward this year.
That inflation data about 2 hours away. The scores in financial markets shaping up as follows. On the S&P 500, negative here by 0.4%. In the bond market, yields lower a single basis point, 416.57. Live from New York City, this is Bloomberg. Stocks slightly down yesterday, just a little bit negative this morning. Same game. We're down about 0.4% on the S&P. We're down a basis point or two on a 10-year, 416.37. Euro not doing much, treading water going into that CPI data later this morning, 107.74 on the euro, and crude, it's the smallest of bounces, 77.42 on WTI. Under surveillance this morning, inflation data on deck.
I think the progress that we're making on inflation is very positive. As long as we have continued progress at the current policy rate, I think at some point it will be appropriate for us to lower the federal funds rate. I don't see that in the immediate future, and I don't want to prejudge what our decisions might be going forward this year.
Here's the latest this morning. Fed officials reiterating it's too soon to ease policy, with January CPI data dropping in just under 2 hours. The median estimate in our survey calling for the headline number to drop below 3% for the first time in nearly 3 years. Jennifer Lee of BMO writing, quote, policymakers and markets will need to wade through some mixed messages between the headline and core rates, but will likely conclude that more evidence is going to be required for the Fed to feel comfortable with the plan to start easing mid-year? Jennifer Lee joins us now for more. Jennifer, wonderful to hear from you. Let's just start with the evidence that these disinflationary trends are broadening out. How much evidence do you see?
Good morning, and thank you very much for having me on the show. I mean, we are seeing some evidence of this broadening out, but it's not as broad, I think, for what the Fed wants to see. You know, this is where the whole sticky, and this is the S word again, the sticky inflation story is still playing out very broadly. And this is like a story around the world as well, which is why we're not seeing central banks cutting more broadly already. Here we are in the first quarter still. But, you know, so I think they want to see, again, more evidence of that playing out and being more comfortable, as Governor Bowman said yesterday, before they can start feeling better about and more confident about cutting rates.
Jennifer, when you zoom out, there's really this existential question. Will the Fed have the conviction and the ability to kill the inflation beast? Will they end up maybe staying on hold, cutting a few times, but facing a resurgent inflation later this year or next year that causes them to have to hike rates again? We heard from Citigroup's Jason Williams over the past couple of days where he wrote, the market should price in some risk of future hikes. Look to 1998. This cycle could be more akin to the 1998 easing cycle, which was short-lived and led to more rate hikes. Do you agree with that?
That would be, I think, a big problem if they cut a couple times and then be forced to raise rates again. And I think this is where you could see a big credibility issue being playing out at that point. So this is what the Fed totally wants to avoid, and this is why they are so hesitant right now to cut rates too early. You know, we had the market completely pricing out at one point late last year, like almost 100% chance of a rate cut in March, and then thankfully, Fed Chair Powell came out last week or 2 weeks ago and basically dismissed that whole idea almost completely. So again, they're just trying to tell everyone to be patient, chill out, sit back, and let's just watch the data and make sure we are confident. And there's all those keywords that they keep throwing out: confidence and patience, and you know that inflation is heading toward that 2% target on a sustained basis. You know, this is what they totally want to see, and I don't think just a few numbers are going to cut it.
So the B word, broadening out, the C word, confidence. How much are you getting the sense that specific components are coming down when it comes to inflation enough to be sustainable over the long term? In other words, do you believe that this is a new inflationary cycle that might be a little bit deceiving in the sort of idea that it truly has been killed?
It has. I think it is. I think that's a great point. I mean, remember just back in the old days, you know, like 4 years ago, when we just looked at headline inflation and core inflation, and now we have to look at all the different various components to make sure not every single one has to be coming down to 2%, but everything or mostly everything has to be headed in that right direction. And now we're looking at things like the super core. We're looking at goods and services. Now, goods inflation has been coming down quite quickly, I think. But services is where things are still sticky because you still have that strong U.S. consumer who's still willing to shell out a lot for travel, for concerts, for gambling, for example, as we saw over the weekend. There's still a lot of strong demand for services, and that's what is keeping services CPI sticky. And again, this is why the Fed, I think, is going to be patient until they're very confident that things are heading in that right direction.
The gambling numbers over the weekend, absolutely nuts. I'll talk about that another time. Lisa, you sensed this in the news conference, I think, with Chairman Powell. He basically told us where the threshold was. I think he was pretty clear about it. The data doesn't need to get better, although some are talking about it broadening out, which would imply it needs to get better. But ultimately, we're saying we need to see more of the same thing. This chairman, and maybe some people on the committee as well, just are not comfortable that they've seen enough yet because they are worried about exactly what you've been talking about, that they start reducing interest rates and then they've got a problem down on the road and they need to start hiking again.
Part of the problem is that people are still getting hired, earning real wages and spending. And you see that consistently across all earnings. You see that consistently. We're going to get Airbnb earnings today. We're going to get some others. The same kind of trend seems to be prevalent everywhere. So then how do you get confidence that really you can kill the inflation beast lowering rates when it doesn't seem to be all that restrictive? We haven't seen that sort of credit tightening that you would expect given how much they've raised rates.
Jennifer, can we talk about the consumer as well? It's not just CPI this week, it's retail sales in a couple of days' time. We've been talking about a consumer running on fumes now for 18 months and it's still going. Jennifer, how strong is that consumer now?
Obviously, the consumer is still in pretty decent shape, and I think it all goes back to the job market. Even though the job market has cooled, we're not seeing job gains of over the 500,000 variety. Of course, 300,000 is still pretty strong, but as long as there is still decent demand for jobs or for workers, everyone is making a decent wage, that I think is enough to keep the consumer going. They don't have to spend it all. They can put some aside for a rainy day, as we say all the time, and that's okay. It doesn't mean that again, whatever you're making, you don't have to blow it all right away. As long as you save some, it's a good thing, and that keeps the whole fundamental support below the U.S. economy going. And as long as, again, wages continue to rise, job demand is still decent, I think that will keep the consumer moving forward, at least.
I'm struck by the polarization of people who we speak to in the new paradigm. Is it going to be a reinflationary kind of paradigm, or is it going to be one where we are deceived by the strength in the economy and there is a downturn that surprises everybody? Earlier this morning, we got small business optimism data out of the NFIB, and actually fell the most since the end of 2022. And here we are talking about the resurgent demand, this incredible strength, how everyone is bullish. What is the risk from your vantage point that we're worried about the wrong thing and that really it is the deceleration that's more present?
I'm actually quite worried. I mean, whenever I see numbers continuing to beat expectations, especially, just like look at the last couple of GDP reports where we saw the initial number in Q3 was like over 5%, 3.3% in Q4. And, of course, I'm always thinking, what are we missing? What is the market missing? But, it all goes back down to the labor market, but it's at some point, over 500 basis points of rate hikes, that is starting to have an impact. And it's just not having as much of an impact as one would have imagined during during normal times. And these are definitely not normal times. And this is why we are sticking for the Bank of Montreal, we are sticking to for our Fed rate cut calls, just not until the second half of the year. I don't believe we're ever in that March camp, and I think June, July is probably the most likely scenario for the rate cuts to start happening.
You're not alone. It seems like a lot of economists on Wall Street coalescing around the same month now. Jen, it's good to hear from you. Let's do this again soon. Jennifer Lee there of BMO on a CPI data that comes out in about 1 hour and 36 minutes time. That CPI data, if you are just joining us, 2.9% is what we're looking for here. Headline, year over year, down from 3.4. Stripping out food and energy, headline for core, 3.7, down from 3.9. Many of you on Wall Street want the month-over-month figure. 0.2% is the estimate in our survey. Stripping out food and energy, 0.3% is the estimate we're looking for month over month. If you talk about the labour market and price pressure, Andrew Hollenhorst has got something to say. We continue to see a stronger underlying trend of inflation, Lisa, due to factors such as wage inflation continuing to move sideways at around 4 to 5%. This is what Jen's talking about.
That basically, ultimately, it comes down to the labor market. And guess what? The labor market is surprised to the upside, whether it's surprising to the upside on the jobs numbers, whether it's surprising to the upside on wage growth, or whether it's surprising, a good kind of surprise to the downside in jobless claims. Here's really sort of the dissonance that I find. Yesterday, everyone's kind of talking about reinflation risk, and then the New York Fed puts out 3-year inflation expectations from consumers. It falls to the lowest since at least 2013. Everyone piles into bonds. Yes, game on. The Russell 2000 rallies. Everyone is waiting to coalesce around that story.
Chris Ferrone, strategist.
Exactly. Completely bullish. Chinese equities.
The equity market broaden out. Take a look at China.
Exactly.
When you hear that, sentiment is pretty high.
So I just wonder, is that sort of the bias right now? People are looking for that confirmation of the disinflation.
This conversation is going to continue. In the next hour, stacked lineup. Jim Zauter of Apollo Asset Management, David Balin of Citi Global Wealth, and Leslie Vidjamuri of Chatham House. That is coming up in the second hour of Bloomberg Surveillance. Going into that CPI print, here are the scores for you. Equity futures negative 0.4% on the S&P 500. In the bond market, yields at 416.37. I went back to have a little look at where we were the last time we got a CPI print. At the close on January 11th, the 2-year that day closed at 424. The 10-year closed that day at sub 4% at 3.96. So yields have shifted higher, and yet this equity market is positive over the same period.
It's positive for the right reason. That's what people say, that yields have been higher just simply because the growth is just so good. And
data was good. Earnings was good.
We can keep going.
You sound fed up with this conversation already.
It's just, it's not that I'm fed up. It's just that we're not going to get an answer.
How do you plan to get through 2024? When it's the middle of February,
How does she
you're
predict
already
the
sick of
snow
politics.
day?
Sick of politics.
Well, give my kids something to do today, and we could have a better, more constructive conversation.
From New York City this morning, good morning. The second hour of Bloomberg Surveillance up next.
It does seem like if it's just steady as she goes, then the Fed wants to be cutting rates this year.
As long as we see this gradual progress down, they should be in a position where they feel confident of wanting to cut.
You're probably going to see a cutting cycle start in May. By May, they should have enough evidence specifically on inflation.
We're also beginning to see more broadly an economy that generally is doing quite well because of the easing of financial conditions.
You've got better economic data. We've still got the prospect of rate cuts coming up, but inflation is coming down. That's a perfect pro-risk scenario.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
CPI data 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market's negative here by 0.4% on the S&P. There's a new bar for some Fed officials, Bramo. Not a bar where you drink, just a threshold to start reducing interest rates.
Well,
TK, if you're listening, don't get too excited. What they want to see is not just more data, they want to see a broadening out in the disinflation story.
I was trying to think of the Jackson Hole bar that, he likes to talk about. But there is this idea that if you start to see other factors other than food and energy really play into why we're seeing such disinflation in goods in particular, then they'll feel more comfortable. It's a new threshold, whether it's just them trying to say something to sort of placate all of the questions. What's your new threshold to actually cut rates? It hasn't moved the needle in terms of market expectations. What will move the needle, though, is if we get this data and we do see shelter and we do see other costs contributing much more to the disinflation.
The data so far this year has given a pause for good reason. We've talked about that really strong payroll story, wage growth beneath the surface. On top of that, the ISM came out, 2 Mondays ago? Prices paid started to click higher as well. There's reasons to just sort of sit back and say, let's wait.
The disinflation has been driven by objects, products, things that people buy. It has not been driven by people going to bars and buying drinks and going to restaurants where you can see the prices are significantly higher because people are getting significantly higher wages. Until you start to see that coming in materially, people aren't going to feel comfortable. The bottom line is this. Can inflation come in simply because this was transitory? Or is this something that is a new paradigm where people are getting paid more and spending more and there's a greater inflationary thrust?
Plenty of earnings out there as well. Just getting numbers from Coca-Cola. We'll go through those numbers in just a second. I just want to turn to the latest down in Washington, D.C. as well. Whenever we talk about price pressure, you need to talk about fiscal policy down in Washington. I know this may not go anywhere, but it's another $95 billion bill down in this Senate in Washington.
$95 billion deal for foreign aid. This would be going to Ukraine, to Israel, to Taiwan, to these national security concerns that the U.S. has foreign, globally. But of course, before the senators even took that vote early this morning, there was a filibuster all night. You heard from Speaker Johnson, who threw absolute cold water on this idea and basically saying the House is going to go its own way and the Senate is not doing the will of the American people. What you see now, and partially what we just discussed with Ambassador Haley yesterday, Jonathan, is this divergence and almost war within the Republican Party. You have these absolute defense hawks who want to send these military weapons to Ukraine, and others who say we should be backing out of foreign aid and have a more isolationist approach.
That increasing isolationist approach showing up in poll after poll over the last year or so. Let's go back to Coke. If we can bring up that stock in the pre-market, not doing much at all, Lisa, just going through the outlook, a little bit better than anticipated.
Yeah, people are still buying Coke, and Ozempic doesn't seem to be cratering their earnings. Adjusted organic revenue is expected to be up 6 to 7%. The estimate was 5.9%, so a little better than that. They do see a 2 to 3% currency headwind for the year. We do hear this occasionally as something that people refer to, given the fact that the dollar is strong, what that does to overseas. When you take a look at the mix, though, nutrition, juice, dairy, and plant-based beverages were up 6%. Water, sports, coffee, and tea unit case volume was 0%, but soft drinks went up 2%. So if this is like the Ozempic mix, it still is,
Are you alluding to the conversation with James Quincy in Davos last month?
You don't say. Yeah, I am.
Is this the pivot that he was basically suggesting?
Well, I'm wondering if that's kind of what's going on. I mean, you are seeing
they already
more
make the goods that
nutrition. People want nutrition if they're going to be, caring about their health more. And you are seeing that increase more than the soft drinks.
And protein drinks and stuff like that. Stock is barely moving, positive by 0.2% on Coca-Cola. The broader equity market story on the S&P shaping up as follows. Equity futures on the S&P look a little something like this. We're just a touch softer. We're negative here on the S&P 500 by 0.5%. In the bond market, yields are lower by a single basis point, 416.57 on a 10-year. Stacked hour for you. Coming up on the programme, Jim Zelter of Apollo Asset Management on the firm's record-breaking year, David Balin of Citi ahead of today's crucial CPI report, and Leslie Vinjer-Murray of Chatham House on the $95 billion aid package passed by the Senate in the last couple of hours. We begin with our top story. US stocks very close to all-time highs as earnings and positive data continue to support sentiment. Apollo Global Management posting a record in 2023 for private credit, the firm reporting more profit last year than the previous decade. Jim Zelter of Apollo joins us now for more. Jim, it's good to see you. You're with us for the hour. Good morning to you.
Good to see you too. Always welcome. I appreciate the invite.
Well, thank you for coming on. Let's talk about these earnings. Well received by this market. What's underpinning these trends for you?
Well, I think it's a repeat of the secular trends we've been talking about over the last several years. Certainly we have a business and an industry that gets better every day as there are more and more retirees and savers looking to think about retirement income on our annuity business. At the same time, you've got an evolving banking system, which I'm sure we're talking about, where lots of companies are looking for a variety of capital solutions. We have the broadest toolbox. But as an industry, it's a secular change, and we've been fortunate to be right in the middle of it. But you're right. We had a business last year that hit on all cylinders. All parts of our business were able to, first and foremost, great investor performance. Assets and asset gathering follows performance, and we did so on a very strong risk-adjusted basis.
You went there early, so we'll go there early. What this means for the banks, there is a sentiment out there. You know how this is portrayed in the media. It goes something like this. Apollo's killing it, the banks are struggling. It's their loss is your win, your gain. Is that how it works for you?
Well, the reality is this is a brutally competitive business, and it has been for the 39 years I've been in the business. Whether you're in the banking side, or the asset management side, or anywhere in between, the competition for market share for assets is always brutally competitive. But certainly it's a great narrative right now. The reality is there's much more of a symbiotic relationship that exists, and we're a major counterparty of all the large U.S. institutions, and even globally in Japan and Europe as well. So it's not certainly on any one transaction, a buyout financing, whether it's going to go to the broadly syndicated market or it's going to go to private credit. These are all they're competitive within our industry, and they're competitive within the banks. That's never going to change. But the reality is the financing that takes place, the counterparty financing that we get from the large institutions, really critical to our business. We provide them a lot of financing fees and opportunities across our equity and debt businesses. So there's a narrative that sells papers, and then there's the reality, and it's somewhere in between.
This is like in high school when they're two friends and they're kind of always talking about each other behind their backs, but they're really polite to each other because they kind of operate in the same circles. I'm just saying, Morgan Stanley frenemies, a little bit. I mean, the idea is Morgan Stanley bolstering its private credit portfolio to $50 billion in the medium term. Goldman Sachs reportedly aiming to double the size of its $110 billion credit business. They want to fight back. Don't you kind of feel that?
Yeah, again, we're in a really competitive industry with the smartest, most determined minds in the globe, in the U.S. and Europe. The reality is, in the end of the day, it gets about your business model, how you fund your business, and the client product that you're bringing to solutions. So there's no doubt, there's no doubt that there's going to be firms that are going to start private credit businesses. But again, let's take a step back. As I've talked to you many times in New York and in London, private credit is broader than just the sponsor buyout business. It's a great headline product. It's a great headline tool. But the reality is that's a $1.5 trillion market. The reality is private capital, private credit is a $40 trillion opportunity. And that's where, when we see what we're doing in terms of aircraft finance and solar finance and a variety of trade and inventory finance, that's where we have a really competitive toolbox because of the structure of our liabilities, the duration of those liabilities, and the cost of capital. What we've really done at Apollo the last 10, 12 years has really brought our cost of capital down dramatically. If you're just in the PE business, your cost of capital is mid to high 20%. If you're in the mezz or distressed business, it's in the teens. When you have an annuity business, And the reality is, in this higher rate environment, more people like to buy annuities. Annuities had a record volume last year. That just brings in a lot of long duration, lower cost capital. So our ability to be very relevant to any client or borrower it's really a defining characteristic.
How much has the money that you're talking about, which is coming from different sources than traditionally, basically been the reason why we haven't seen the credit cycle that so many people were expecting?
Well, I think it's a very interesting question. I think what's going on right now, and I know you had Torsten here yesterday, is, last year you had the equity markets up 20-something%, broadly speaking. And at the end of the year, you had defaults approaching almost 5%. That's a pretty unique characteristic. Usually when you see defaults rising like that, you have a declining economy. The strength of this economy has befuddled economists and all your guests for the decade. And if you look at where all the dot plots have been, even those folks who have all the information have missed this. Now, I think once we all say that there's not going to be a cycle, I do think you are seeing some signs of a hardening of economic conditions that are finally coming up. We'll see it in the next few weeks. I think the Fed's made the right choice. I think I talked several months ago here about the Fed put us back. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left in that gun. But I do think there's a modern economy that's going on right now. The depth and breadth has surprised economists and guests across the board. And it's a much more resilient economy. The U.S. economy is the bulwark of the Western world right now. It really is.
Economy's strong, and I think you told us before Christmas, basically the Federal Reserve has the space now because of lower inflation to respond to negative shocks. What I'm trying to work out, though, of the issuance that we've seen so far, and this is more in public markets where Lisa and I have been talking about this boom in supply to start this year and this flood of demand. Is that because the economy's strong, or are we just anticipating lower rates this year? Which one is it?
I think it's a combination of, the U.S. consumer has prepared themselves very well for a higher rate environment. Corporate balance sheets have prepared themselves very well for a balance sheet. And when people see financing opportunities, they know now that, don't wait around for perfection. And I think that's been a good lesson. Don't let perfect get in the enemy of progress. And I think there's been a very, very thoughtful, there's no doubt there is, when people see what's going on where rates were supposed to be going, there has been a rush, and there is a risk on trade right now in virtually every asset class. The market has priced to perfection in virtually every asset class, and that means it's a good time to issue. I'll tell you, for us, we typically underperform in periods like this. We have a lot of cash on the balance sheet at Athene right now. We're very low levered. We've put ourselves in a position, if there are pockets of volatility, we're going to be well positioned. But that's how we prudently, when we have a macro view, that's how we express it.
It's a classic approach. You want to be the liquidity provider in times of stress. It makes perfect sense.
And I think the story that really has not been spent a lot more time on, this issue of market structure, the rise of passive, the lack of companies' ability to really do, the equity market is, and the equity IPO market is fundamentally challenged. And I know SPACs were not the answer. But in our view, that this market structure issue has been going on for several years. It's going on for a decade. And the advent of passive in scale, now more than 50%, I think that's going to have profound implications on how companies raise capital going forward.
We've got time to work through that, through the ad, because luckily you're going to stay with us. You mentioned credit stress. In fact, that's my word. I can't remember the word you used precisely, but I do want to ask you about that. Are you seeing pockets of stress right now? NYCB, commercial real estate, we talked about it for the best part of 5 minutes, market moves on. What are you seeing?
I think you are seeing, in a very broad growing economy with massive fundamental strength, you're seeing some situations where companies either poor business plan or way too much debt and have not maybe recovered from the COVID crisis. You're seeing that a little bit more in the corporate world. In the U.S., the U.S. consumer, the average mortgage is 3.8%. We've not seen the pain that's been seen in the U.K. and Germany. That's really protective. So you're seeing some signs of challenge and weakness, but there's been a tremendous amount of private equity activity and financing activity the last 5 to 7 years. So the fact that you're going to have some stray challenges around the edges, interesting. I don't think it's a macro telltale sign of things changing. but there are challenges out there, no doubt.
Jim, it's great to have you with us. Jim Zelter of Apollo Asset Management with us for the next 45 minutes or so. Your equity market on the S&P pulling back by, let's call it 0.4% on S&P 500 futures. Here's an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. New York City residents are being urged to stay home today. The city's forecast to receive up to 8 inches of snow. Mayor Eric Adams closed public schools and moved students to remote learning. 7.3 inches of snow in Central Park would be the most since January of 2022. Areas north and west of the city could get as much as a foot. Areas of New Jersey, Pennsylvania, and New England could see as much as 12 inches today. Shares in JetBlue are higher in the pre-market trade. Activist investor Carl Icahn disclosed a 9.91% stake. Icahn is now JetBlue's third largest shareholder behind BlackRock and Vanguard. The stock fell 30% in the last year. Federal court struck down an alliance with American Airlines and a planned takeover of Spirit Airlines on antitrust concerns. Icahn said that he's had talks with management about a board seat. And shares of Manchester United are climbing today. Billionaire Jim Ratcliffe said he'd extend his offer to buy a 25% stake in the club, pushing the deadline to Friday. In December, Ratcliffe said he would purchase the stake by allowing investors to swap 1/4 of their Class A holdings for $33 per share. That's well above the market price. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the programme, investors looking ahead to CPI.
I think the inflation news is going to be okay for now. I think the growth news is going to continue to be good. So, look, no one's really worried the Fed are going to start hiking again. We're going to keep that prospect of rate cuts out there.
Live from New York City, that's next on the programme. The data 1 hour and 15 minutes away. Inflation data just around the corner. Here are the scores going into it on the S&P 500. Equity futures a little lower. We're negative 0.4% on the S&P. Bond yields lower by 2 basis points. 4.1599 on a 10-year. The euro not doing much. 107.78. Under surveillance this morning. Investors looking ahead to CPI.
I think the inflation news is going to be okay for now. I think the growth news is going to continue to be good. So, look, no one's really worried the Fed are going to start hiking again. We're going to keep that prospect of rate cuts out there. I think we do get to 4.5% on 10 years. So I would be short duration here. That fits with the story of better economic growth, pushing out the rate cuts. And if inflation does come back more meaningfully, I think you're going to see that curve steepen up. So
here's the latest this morning. CPI data due out in just over an hour from now. The median estimate in our survey calling for the headline number to drop below 3% for the first time in nearly 3 years. David Bailon of Citi writing this, signs of economic growth and recovery are spreading faster than most economists believe possible. Perhaps all the rate increases and restrictive monetary policy on the past 18 months won't slow the economy in 2024 very much. David joins us now for more. David, I wrote it down. Need to be careful how I read this just to get it right. Is the slow then grow becoming the grow and grow? Your words. Is that what's happening, David?
Yeah, that's sort of the big surprise, Jonathan. We actually are seeing no slowdown. We expected the economy to slow at the beginning of 24, and it's not. A lot of reasons for that. I think the consumer has stayed, healthy. Like you said, inflation is coming down. We actually see real increases in wages taking place starting in November all the way through now. Very healthy consumer balance sheets, right? And really the end of inflation. The big story that's happening for the consumer has to be that import prices now are negative. We're importing at 3 to 4% less cost from China than we did before. And that is rolling through our economy. So when you take a look at the consumer continuing to buy, what we see is an increased amount of consumer confidence. And you can see that in the Michigan index over the course of 2 out of the last 3 months. That index is up considerably. All of this, right, is going against the fact that the Fed has kept rates higher for longer than we would have expected. And that, is really the quick story of the beginning of the year. Things are going better than we thought.
Consensus was bullish coming into the year and bullish on the idea we got early rate cuts. We've pushed out those rate cuts off the back of the data that you just described, and yet we are still bullish. Have you changed your market call off the back of this data?
No, actually, I think our market call is more bullish in terms of both earnings, right, and potentially what the S&P, could do for the year. We've seen a pretty big pickup in the market across a broadening sectors. We've seen, small and medium-sized industrial companies, up 21% for the year, things like that. So I think what we're seeing is that the market is telling us about what the economy is likely to do over the course of the next 6 months. And that will then turn up, Jonathan, in our earnings, right? We thought earnings would be up 5% this year, and it could be that they're up 6 or 7%, which is, again, considerably more than we would have expected. All of this supports the market activity, but it does support higher rates for a longer period of time.
I wrote this down just so I could get it right. Is bull then bear becoming bull then bull? I mean, is that essentially what we're talking about? Because people were expecting some sort of deceleration later in the year. At what point, since I like to worry about things, does bull then bull lead to a resurgence in inflation?
Yeah, Lisa, that's the thing that I think people are worried about that is least likely to occur. Citi Wealth's biggest call is on the fact that inflation is going to stay moderated. And there are lots of reasons for that. Input costs, finished costs coming in from abroad, the fact that we don't have materially increasing labor costs in the United States, and the fact ultimately that the economy has normalized after COVID, so the supply chains are working. All of that suggests there's no reason to believe that inflation is going to be our bigger problem.
Given that, there is a sort of question around your colleague, Jason Williams, writing this when he was saying the market should price in some risk of future hikes. Look to 1998. This cycle could be more akin to the 1998 easing cycle, which was short-lived and led to more rate hikes. Are you baking that into your expectations, or is it sort of to each his own because this is basically pick your own adventure, depending on who we talk to? I mean, honestly, it's a very confusing moment.
It is a bit confusing, but I think that the Fed is signaling to us that they're going to be very prudent about not lowering rates quickly, but there's no indication that there would be any reason to raise rates. And so what we could have is a very shallow, upwardly sloping yield curve, that rates don't go down as much as we thought they would 6 months ago. Again, we thought that it was a 350 to 375 10-year at the end of this year. That may not happen. The bigger story is going to be equities. And the fact that, last year, fewer than half of the equity sectors were, had positive earnings. This year, we think it'll be 90% or more, 2025, all of them. And I think that the equity story and the ability for equities to go considerably higher as earnings become clear is what we have to focus on. And there are fewer and fewer value parts of our market, with the exception of areas like healthcare. There are indications that that markets are anticipating everything we just talked about.
Hey, David, great to get your views, sir, an update on them. David Baden there of Citi. With us around the table, Jim Zauter of Apollo. Jim, can we talk about public markets for a moment? Nvidia and Microsoft, I think, are as big as the Euro Stoxx 50 now. Is the big just going to get bigger? You talked about the evolution of passive flows over the last decade or so. Have we tested the limits of that yet, just in terms of the big continuing to get bigger?
I don't think we've tested the limits, but there's no, the impact of the Magnificent Seven, and if you look at the valuations, other than Alphabet, they are dramatically higher than the broad indexes. And the manner in which capital formation happened for hundreds of companies is certainly changed. But yes, the Magnificent Seven have had a spectacular impact on performance. And if you're not, as a equity manager, which we are not, if you're not participating from that group of stocks, you will indeed underperform, which most folks have done.
Is there an analog in the credit world, though, where basically big companies do better, have better performing credits, and that's sort of a sweet spot for you, that you go after big companies with bespoke solutions that you go after because you're confident they're going to survive in a different way than smaller businesses that don't have the same sort of strength?
Certainly that is the key to our view of the markets today. The traditional, I've been in high yield since the mid-'80s, a little aged, but the single B, $300 or $400 million single issuer of high yield bonds, no one really wants to buy that today. That is a dinosaur of the past. Those companies are certainly using the private credit where they can club a transaction. But for our business at Apollo and several of our peers, we're focusing a big portion of our origination on investment grade quality risk. We have the scale and capability to do so, but yes, there's no, when you are concerned about an economic cycle that people have been concerned about since really 2016, 17, where's the credit cycle going to end? You constantly wanted to go higher and higher in credit quality, larger companies, less commodity or one risk companies. The best thing, one of the best things that happened in our platform is we went through 2016 and we learned a lot of lessons from investing in and around the energy complex with debt, which we will not do again. And very, very different scenarios today.
We're going to tease more of that out in just a moment. Jim Zauter sticking with us. Coming up, the AI rally continues. Meta and Nvidia leading gains in the S&P 500 so far this year. That conversation's up next. This Here's Bloomberg. Live from New York, 60 minutes away from that inflation data. Equities look like this on the S&P 500, pulling back session lows, but only down about 0.5% on the S&P. On the Nasdaq, down by 0.75%. That's picking up. The small caps, the Russell, negative by 0.4. In the bond market, 2-year, 10-year, 30-year yields higher over the last month or so off the back of stronger than expected economic data. Yields this morning on the session lower by a couple of basis points, 416.18. On the 2-year, 446.77, really close to 450 here, Lisa, off the back of stronger payrolls, stronger ISM, services and manufacturing. Jobless claims last week, a little bit lower than anticipated.
Basically, pick your data point, and other than the small business optimism this morning, everything's been performing better than expected. We see the Citigroup Surprise Index, Economic Surprise Index, surging to the highest levels going back to November. Again, the key question is, when does this create an inflationary problem? And we heard from David Balin, bull then bull, because essentially it's not going to be as much of a problem. And that seems to be what's getting baked into the market.
And now he's even more bullish, apparently.
I guess that's the theme of the morning.
Yes.
It's that bulls are getting buller.
Basically. Is that how you're framing it? Bulls are getting buller.
I mean, that's essentially where we're at right now.
I'm just looking for the headline in the newsletter a little bit later.
I'm working on it. I'm kind of playing around here.
Good. Okay, keep playing with that.
Thanks.
In the FX market, conversation about who cuts first, ECB versus the Federal Reserve. Based on the data so far in the US, that Fed call's been pushed out. The euro slightly positive by 0.1%, 107.82 on the euro against the dollar. Under surveillance this morning, US CPI data 60 minutes away. Bloomberg survey forecasting an annual read of 2.9%. This would be the first read below 3% since March 2021. Core CPI expected to jump year over year, but would still mark the smallest advance since the spring of 21. Bloomberg Economics also expecting the report to show less disinflation in core goods, but more in services. And Lisa, that's the handoff we're looking for.
The broadening out as we try to get to some sort of confidence that this can continue. This is going to be a very analyzed report. You're going to get the headline figures, and then the real analytics is going to be what people are looking for. How much is being driven by services? How much is being driven by food? How much is being driven by rents? How about those healthcare bills? How about the car insurance? That's been surging. So at what point does that come down? And suddenly people start to get a little bit more confident.
And then it gets very personal very quickly, and people start to say, that's not where inflation is. I'll tell you where inflation is. The Fed's going to tell you what it thinks about it. Goolsby speaking a little bit later this morning, then on to Mr. Barr, and then you're going to hear tomorrow, rather, Goolsby and Barr, then on to the following day, Waller, Bostic, then Barr and Daly. Plenty of Fed officials this week, Lisa, to respond to this.
And maybe they can also talk about the broadening out kind of thresholds. The key question is, we've heard from a lot of Fed officials, what have we learned?
Very little.
Yeah, I mean, I don't really have a sense of any more clarity.
One thing stands out. There was a takeaway from the last news conference that maybe Chairman Powell was struggling to herd cats. You were talking about it. I've heard very little difference in between the Fed speakers that we've heard so far over the last couple of weeks. They all seem like they're on the same page to me.
It's a great point. The one differential is, what is that threshold that would allow them to cut rates? Maybe that's where maybe some of the daylight is coming. And so maybe these sort of broad concepts like confidence and broadening out become subjective and become momentary, pauses in their consensus. But this is a good point.
As we like to say, maybe a difference in degree and not kind.
Correct.
We're having a conversation about maybe a separation of a couple of months. Maybe some people want to go in June, maybe some people later. I'm not sure how much value is in that.
They're still cats. They still want to go.
Let's herd cats down in Washington. Do you want to do that? We could herd cats down in D.C. and the Senate and the House as well. President Biden pushing for a 6-week pause in fighting between Israel and Hamas. The president making the comments alongside the King of Jordan. During his visit to the White House, Israel Prime Minister Benjamin Netanyahu vowing to continue a military campaign in the south of Gaza, where about 1 million people have fled during the course of the war. Earlier on this morning, the Senate passing a big bill. What is it, $95 billion of aid?
That's right, $95 billion of aid for the U.S. national security concerns around the world, Taiwan, Ukraine, and Israel. Now, while it does feel like they're moving in the right direction in terms of what the president's priorities are, we know that this is at the moment dead on arrival in the House of Representatives. Speaker Mike Johnson came out before they voted basically saying, you do that in the Senate, we're going to go our own way. But it's an important day for the president when you talk about the hostage negotiation, because you do have his top diplomat, Bill Burns, the director of the CIA, in Egypt with the head of Mossad. So potentially if there's going to be any movement on a hostage negotiation, we could see that incremental move today.
On a lighter note, here's an update for you on the Super Bowl figures, setting a new record for television viewership. CBS saying 123 million people tuned in to watch the Kansas City Chiefs defeat the San Francisco 49ers. That's a 7% increase from the previous high, which was set last year. The numbers include both the CBS network and the parent company's streaming service device, Paramount Plus also delivering the most streamed Super Bowl ever. Just amazing, Bramo. Altogether, 123 million.
So I did some field research last night at the dinner table, and I have to say there were a lot of hate watchers. You know, there are people who watch because of Taylor Swift, and then they're the hate watchers because they kind of hate that she's the main thing, and they think that she's wrecked football, but then they're watching because of her. And it was just, you know, there are a lot of passions.
Taylor Bowl.
Yeah, well, I mean, I don't want to go there because I'm going to get hate mail because the haters want to hate.
And they don't want to talk about it either way, but we can talk about how dominant NFL has been on viewing figures over the last 12 months. Just absolutely dominant. There is no other game in town. Which is the reason why everybody wants to buy these rights, and which is the reason why how can you sort of create a bundle or something like that that can get said rights in some sort of consolidated place, because that will be the secret.
Just think if there was an event in America before a massive presidential election where you can talk to 123 million viewers.
And then you skip it.
And you decide to skip it.
I still can't make sense of it. Why did he skip it?
Well, I think, I spoke to some people in the campaign who say it's still so early on in the season. I also think the fact of the matter is there's a lot of questions right now about the president's mental acuity, especially coming after that report. And potentially they thought that this would be the wrong message he wants to send. He clearly wants to send a message about the economy. He was out again speaking yesterday about the economy, labor market doing well, inflation coming down, the little bit left inflation that you're struggling with at home. It's corporate greed, it's shrinkflation. But yeah, they skipped it. And a lot of critics are saying this was a massive missed opportunity, especially when you look at these record numbers at the Super Bowl.
Jim, if you could get a baseball cap and write Apollo at the front of it and put it on top of Travis Kelce, you would, wouldn't you?
We did it with Patrick Cantlay.
It's working out, that is.
Working out well.
I messaged you the other week. I saw Cantlay on TV on a golf. How does that work? How much response do you get to something like that?
Well, I think it's a first foray for us in thinking about connecting our brand with a broader audience. And, for us, we've got a 33-year, 34-year track record, but most people still think of us in what we used to be as a PE firm. We're now a much, much broader platform. So a lot of it is just client and brand positioning.
Elisa's laughing because she noticed how I got from football to golf.
I mean, basically, Super Bowl to let's talk about golf.
Let's talk
that's
about
more
golf.
interesting.
I think I'm a Buffalo Bills fan, so it was a hard game for me to watch. It's been a tough.
Jim, you're
slide.
talking about how this brand's going to change. Can we just talk about how 401ks might change as well? Rowan on the call in the last week or so, you know where this is going. You talked about Altsin 401ks. How is this all going to change in the weeks to come, months to come, years to come?
Well, Mark pointed out the great irony of the whole idea of DC and savings for 20, 30, 40 years, and yet because of the systematic structure really mandating daily liquidity product. And the idea that, liquid is safe and illiquid is risky, I think that paradigm really needs to be questioned. When you look at where returns are over the last decade or so, we're talking about market structure, we're talking about the advent of passive, and when you look at actual underlying performance of a variety of so-called illiquid alternatives, they've performed in a robust manner across a lot of cycles. And that's taking notice from investors who are long-term. The so-called endowment model for the last 30 years has taken advantage of the liquidity structure which they do not have to live by. And so if you have a broad DC market that has long-term objectives of retirement income and retirement safety, why are we exposing them to the most liquid, volatile aspects of an asset class? Well, it doesn't really make a lot of sense.
There is a concern that if you have people who have the ability to withdraw on a daily basis and they're investing in longer-term investments, that it creates a potential for a run on those assets, that if there is some trigger and people do decide to withdraw their cash, it creates forced selling that can create a spiral.
Well, they already do actually. If you're in a DC plan, you're in daily liquidity mutual funds, which you can redeem any day right now. So that institutional structural liquidity drain is already in the markets. I think that we've been very careful, as many of our peers in the alt set, not to offer daily liquidity products because we never want to get into that asset liability mismatch. The whole reason why annuities have done well the last several years, but exceptionally well in the last year, is because that there's the longer duration of those vehicles to be able to reinvest and have the long duration versus a savings account that we saw what happened with SVB or other bank challenges.
Are you worried that in an environment where everybody wants exposure to private assets, that there are bad actors that are offering things like daily liquidity, underlying investments that are much longer term, that could create forced selling, that could create something that you don't want to be next to?
You always have to understand what the weakest competitor may do. But when you go back over the last, in my career, you know, the one that really sticks out to me is the idea of the UK pensions in, 4 or 5 years ago with the LDI crisis. Those are the ultimate long duration investors that because of moves and gilts had to sell all their CLO liabilities. So we have great concern over this corner, but the reality has happened in a very, very different neighborhood. And so, yes, you have to always be, I do think it's interesting that all the public and all the leading alts folks have not gone into the daily liquidity product. And that will be a question on what types of vehicles, if you were either a provider of those or a parts provider for larger firms, how you go down that path. But certainly we're very, very focused with the discipline of making sure that we can never get pulled away from the table on an investment mandate. That's one of our critical philosophies of how we invest.
I just want my 401k right now to be max long, one name, ARM. ARM has basically doubled in 3 days. Can we bring up the chart quickly and have a look at this? A 3-day rally driving the stock up by almost 100%. The winners of the year, basically the winners of the last year, Nvidia and Meta on the S&P 500. Nvidia briefly overtaking the market value of Amazon during yesterday's trading. Mandeep Singh of Bloomberg Intelligence is with us around the table. Mandeep, are you calling this a frenzy yet when you see moves like that in ARM stock?
I think so. I mean, look, in this case, all of the stock move is not validated by earnings revisions. And as a fundamentals guy, you want to see that estimates go up and catch up. And, when there's a 90% move and the estimates have been revised 2 to 5% upward, that tells you there is a lot that you are paying up for future earnings. And that too, who knows what the normalized level of earnings is. In the case of chips, what we have seen in the past is the supply tends to catch up. Look, Nvidia definitely has a moat, we get it, but there is that supply component. Right now, every R&D resource is being invested into developing a chip that can train large language models. How long can they sustain that moat? And stocks are long duration assets. So you are paying for, 20 years forward in terms of earnings, which we don't know what the normalized level of earnings is.
Who do you think is behind this kind of move? Is it retail investors that are thinking we just want to get ahead of the next Nvidia? Or is it fund managers who've been caught off sides and want to get even more bullish? Bull becomes bull in a world where everybody feels like inflation will come down and growth will continue.
I mean, there's both, actually. And the reason I say that is there is a fear of missing out that, things have already gone up so much. And it hasn't translated into real revenues. We've seen that only 2 companies, yes, Nvidia actually is showing that data center revenue growth, but we don't know if it's going to be the case for the next 10 years. And in the case of Microsoft, yes, they got a lift from AI revenue, co-pilots. But all others, including ARM, you have to ask yourself, where are the real revenues and how long it's going to take, for them to show up in the numbers? And I think right now everyone is chasing that because they know there is a clear catalyst, Fed funds rate coming down. Their tech stocks have a sensitivity to, interest rates, and that's part of it. And look, AI wave is real, but we are setting ourselves up for, a disappointment where the revenues don't translate as quickly as, the multiples are suggesting.
It's certainly real for Nvidia. The numbers are a week tomorrow. What are you looking for from that name?
I mean, they have to beat and raise by at least 10%
Constantly.
to 20%. Even 2% or 5% is not enough because they've set expectations like that, for the past 3 quarters. And they may very well do that. But again, if you are investing in a long duration asset, you have to ask yourself, how long can they hold this mood for? And right now, the market isn't thinking like that.
They certainly did it all last year. Mandeep, it's good to see you. Mandeep Singh there of Bloomberg Intelligence. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bitcoin touched $50,000 for the first time in over 2 years. The latest rally has been driven by the U.S. approval of a spot Bitcoin ETF. The token tripled in value since the start of the year, but still remains roughly $19,000 below an all-time high. The U.S. Senate has approved a $95 billion bill for assistance for Ukraine, Israel, and Taiwan. But now the legislation faces an uphill battle in the House. Senators sat for an all-night session to debate the bill, passing it 70-29 early this morning. Republican leaders in the House demand that President Biden take action against undocumented border migration before passing any Ukraine aid. Voters in Long Island will pick a replacement for disgraced former Representative George Santos today. The contest pits Democrat Tom Suozzi against Republican Mazi Melissa Pillup. The race is viewed as a referendum on President Biden's policies. Snowfall across New York region could impact the turnout. That's your Bloomberg Brief. John.
Danny, thank you. We always say this, don't we? Turnout is so important. It's like the cheater's guide to political punditry. Turnout. Who's it more important for?
Well, it's important for both of them if you look at the makeup of this district, because there's so many voters who are not decided Republican or Democrats, and it's a swing district when you look down ballot, less as presidential elections. That is why everyone is focused on the snow today, Jonathan.
Turnout. The weather, turnout. I get that piece of it, obviously. Up next on the programme, making a case for aid to Ukraine.
The reason people should care about Ukraine is because, one, it's a pro-American, freedom-loving country. But two, listen to what Putin said. Putin said once he takes Ukraine, Poland and the Baltics are next. Those are NATO countries. That immediately puts America at war.
That conversation is next from New York. This is Bloomberg. CPI data 42 minutes away. Equities going into it negative here by 0.4% on the S&P 500. Yields coming lower by 2 basis points on a 10-year, 415.79. Under surveillance this morning, making the case for aid to Ukraine.
Our whole goal is to prevent war. That's the main thing. I mean, you look at Russia right now. The reason people should care about Ukraine is because, one, it's a pro-American, freedom-loving country. But two, listen to what Putin said. Putin said once he takes Ukraine, Poland and the Baltics are next. Those are NATO countries. That immediately puts America at war.
Republican presidential candidate Nikki Haley stressing the importance of support for Ukraine, saying it's only a matter of time until Russia invades a NATO territory and brings the US into the war. Here's the latest. The Senate passing a $95 billion aid bill for Ukraine, as well as Israel and Taiwan, setting up a showdown in the House. Joining us now is Leslie Vinjamuri, the head of US and America's program at Chatham House. Leslie, let's talk about the response to the comments from President Trump over the weekend. The NATO Secretary General obviously pushing back. Germany's Scholz saying Trump's stance is irresponsible and dangerous. To what extent do you think recent comments undermine the collective defense clause of NATO?
Well, it creates this tremendous uncertainty about where America's commitment to NATO is going, where America's commitment to transatlantic security more generally in this run up to the election in November. And it's not helped, of course, by the struggle to get that what's now called, I guess, a foreign aid package through the House. It's just passed through the Senate, as we've seen. But the antics surrounding that, I think, alongside Donald Trump's comments really unsettle European leaders, as they should. And, you know, some people have turned this into a conversation about pushing NATO members to get up to that 2% of spending on defense. That's, you know, a serious, significant, ongoing concern dating back to 2014, before Donald Trump. But the broader concern is, you know, we have a leading candidate, likely to be the Republican nominee, former U.S. president, saying that he doesn't care what Russia does to America's closest allies. It is dangerous and unsettling, to say the least.
Leslie, for European leaders, though, don't they feel like they've heard this before, whether publicly when he was former president or in those behind closed doors meetings, and view it as Trump using it as leverage to force European allies to hit their 2% defense target?
I think that nobody's certain what comes next if Donald Trump returns to the White House. There's a very clear sense in Europe and across the world, I believe, that Donald Trump in his first term was a man who didn't expect to be president, who had a lot of ideas and beliefs, who was scrambling from one set of administrators to another. But that as we look ahead to what he would do, that his set of ideas and that the 900-page document, Project 2025, that Heritage has put out, a future of a conservative America, which includes statements on foreign policy. This is a president who, despite the fact that that report doesn't specifically align with Donald Trump, it's clear that this is a former president, a future candidate who has a much more serious intention and plan for what he would do if he returned. He didn't pull the U.S. out of NATO. He talked about it. He created that uncertainty. But I think were he to be reelected, we would be looking at a very different president than we saw 2016 to 2020.
It also looks like he's putting a lot of pressure on a lot of Republicans right now in Congress to move away from aid to Ukraine. We did see it pass in the Senate very early this morning, but it's pretty much dead on the arrival right now when it goes to the House. Where do you see the U.S. assistance to Ukraine this year? Do you think this just doesn't get done?
I mean, I keep thinking that this gets done because what we know as we speak to members of Congress, members of the House, is that there is a majority, so we're told, a silent majority of members who would like to see this defense support continue for Ukraine. But the rupture in the Republican Party is truly extraordinary. Lindsey Graham, who regularly travels to the Munich Security Conference, has said he's not going this year. That starts on Friday. He's going to instead travel down to the border. Mitch McConnell standing up and voting in support of defense of Ukraine. That is, one obvious example of the split in the Republican Party. But with, President Trump lurking in the background as a former nominee, putting that emphasis on border security, and quite frankly, not wanting to see a deal, wanting to play the role of disruptor in order to blame President Biden around something that's very serious. We know the problem of immigration is grave. It needs a solution. But it's really turning into a sharp point for the Republican Party. Will they be able to get that support through for Ukraine? It's very hard to see the path. I still believe that they will, but it's hard to map it out. We need some really clever people to figure out how that's going to happen.
It's a struggle. Leslie, appreciate your time today. Leslie Vinjamuri there of Chatham House on the latest effort down in Washington. With us around the table still, Jim Zauter of Apollo. Just a few minutes left, Jim, to have some final thoughts with you. You've alluded to this in the last hour, just how much finance has changed in the last 25 years or so. Can you walk us through what this is going to look like in the next 10? The shift from public to private, these flows that we've seen dominate, passive flows dominate of the last 10 years. What's this going to look like in the next decade?
Well, I think that the whole concept of open architecture, we were very much defined in the tailwinds of the last 30, 40 years, globalization, technology, lower rates. There's been a massive growth in the global financial markets that took place before the GFCs, post the GFC, lots of regulation and rules, but the monetary policy really had a massive impact. Now we're getting to a level set of the reality of the future. So I think it's going to be the large dominant players in capital formation and fixed income and alternatives in the equity in banks. They're going to play on a global stage, but it's going to be much more in an open architecture manner. People are going to partner with folks more than ever before. There's going to be an opening of how people think about alternatives and retirement savings. You've seen what's happening in Canada, you've seen what's happening in Australia, we see what's happening right now in Mexico, recent travels of ours. So it will be, much more longer term retirement savings, guaranteed income, but there will be a lot more open architecture in all other sides of the asset management business.
20 seconds. Who's your biggest competitor going to be in the next 5 years?
It's going to be a combination of our existing competitors today and partnerships that they create with financial institutions.
It's not going to name them, Bramo.
Come on, just for the panel.
Signpost them.
Yeah.
Throw in some banks there.
I want to know if it's, banks, if it's, different asset managers, or if it's tech companies. Is it going to be Apple?
I think, again, I go back to our structure. It's very, people like to talk about transactions or competitors today. You have to have a advantage of the products that you are delivering to people. In the end of the day, you can have great headlines and great ideas, but you got to deliver product. You got to deliver
some media drama, Jim. That's all. Jim, it's good to see you.
I'm here to invest.
Appreciate the hour. Jim Zalta of Apollo. Jim, thank you, sir. Coming up in the next hour, David Kelly of JP Morgan Asset Management, David Herro of Harris Associates, Sarah Malik of Nuveen, Jay Bryson of Wells Fargo.
The inflation problem is not going away. That will continue to create more and more risk of financial stability issues down the road.
I do see risks building that, could perhaps jeopardize this smooth disinflation.
Basically, every single investor pricing in a soft landing, which again gets me quite nervous.
All we need is a tiny whiff of less dovish data, and it, I think, would already be enough to send a bit of pain across all the asset classes.
If we were to get an upside surprise on CPI, then folks might say, wait a second, is this thing really overheating?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. Alongside Lisa Abramowicz, together with Annmarie Hordern, I'm Jonathan Ferro, 30 minutes away from a CPI report in America. And Lisa, we're looking for a two-handle on headline inflation.
And frankly, my takeaway from this morning is people are looking at it for an excuse to be more bullish, and that if you get an underwhelming or a downside surprise to the CPI report, watch out. It will be a rip-roaring rally, because that seems to be the tone that we're hearing from everybody.
So what are we looking forward today? Basically something in line a beat, just more the same?
It depends exactly where. It depends also how people are feeling. But honestly, kind of, yeah, because we're going to be dealing with potentially the lowest inflation read going back to early 2021, at a time where people are starting to sniff out maybe a broadening out, maybe not. I don't know. It depends on your bias.
Well, it's really important also to what's playing out at the White House in Washington, D.C. Their timeline is on their line, they hope. They continuously tout things like the Michigan survey, the Conference Board. People are starting to feel better about the economy. This, for them, is that last hurdle, especially when it comes to inflation. And they want to make sure that people are feeling better about their purchasing power, because the jobs market, the president will remind you today, I'm sure, when he gives out his inflation statement, has been unemployment under 4% for 2 years. But can they get over this final bump?
Amazing to see, sub 4% at the moment. Sub 4% is where the 10-year yield was on the last inflation print. This is where we are right now, north of 4% on a 10-year this morning. The scores look a little something like this. On the S&P 500, negative by 0.4%. Yields down 2 basis points on a 10-year, 415.60. That's the price action, the market moves. We'll get you a weather update for the tri-state area in about 10 minutes' time. We'll catch up with Danny Berger, so look out for that with Danny in just a moment. Coming up through the hour, David Herro of Harris Associates looking ahead to CPI. Nuveen's Sarah Malik on concentration risk in the equity market, and JP Morgan's David Kelly on what today's inflation print means for markets. We'll be given the top story, counting down to US CPI, the crucial inflation report coming in less than 30 minutes. The headline number potentially dropping below 3%. Year over year for the first time since 2021. Equity markets in the United States near all-time highs, and hopes that maybe this rally can broaden out beyond the Magnificent Seven to things outside of the US, in Europe, and perhaps even Asia. David Herro joins us now for more, the CIO at Harris Associates. David, wonderful to catch up with you, sir. Can we talk about the opportunity set beyond the Magnificent Seven into Europe and elsewhere?
Well, especially for investors like ourselves who focus on company-specific factors, valuation metrics, which is low price, high quality at Harris Oakmark, it's a really good set of opportunities outside the United States, particularly in Europe, where, in essence, you can find high-quality businesses, 10, 11, 12 times earnings, sometimes 6, 7, 8 times earnings, yielding more than the price-to-earnings ratios, generating lots of cash, excess cash on balance sheets, free cash flow yields, low double digit. I mean, all these valuation metrics for us are just happy hunting grounds in essence. And
not just you, David. I'm going through some names. Novo Nordisk, GLP-1's a massive deal over the last 12 months. Everyone balled up on machines for chips, ASML, luxury players, LVMH. David, we've seen big moves in these markets. I want to be clear about that. As you know, the likes of the DAX and the Stocks 50 had brilliant years last year, just not as good as, say, the NASDAQ 100. David, can you describe the sectors, the kind of companies that you're focused on, if they're not these big headline-grabbing names of the last year or so?
Yeah, the headline-grabbing names are actually blinding investors from what's beneath those names. And take companies in Europe, the financial sector, major financial institutions like BNP in France, Intesa in Italy. These are companies that literally trade at 6-7 times earnings, yield almost 10%, have excess cash, are buying back their shares at an aggressive amount. And everyone kind of forgets about these because they are being shielded or blinded by these theme stocks like the GLP-1s, like the semiconductor companies. Industrial is the same thing. If you look at the German premium automakers, BMW, Mercedes-Benz, both trade at about 4 or 5 times earnings and yield almost 10%, and again have so much excess cash on their balance sheets that they too are buying back shares. So these are the types of businesses no one seems interested in. No one is focused on cash flow and valuations, which to us provides an opportunity, because eventually we'll come down to earth and we'll look at what makes a business valuable, and that's the cash which it generates.
Eventually we'll come down to earth and people will stop buying ARM and piling in on the heels of their earnings, but maybe not yet. David, love speaking with you. I do want to go to BNP because there was an issue with Credit Suisse, and I know that was sort of one stock that you got fully out of after being a heavy investor last March. What did you learn from that episode that colors your investments in European bank stocks today?
First of all, in any bank stocks, what you have to do is be able to price uncertainty in some of their businesses, because you don't have clear transparency into the assets of every single bank. What you have to rely upon is A, the accounting, and B, the reputation and the quality of the management team. What we got wrong with Credit Suisse was we believed that at some point they would be able to turn around their investment bank. The other 3 areas of the business did just fine through the cycle. The private bank, the asset management, the Swiss Universal Bank. All the strengths in those 3 businesses were blinded by the ineptitude of the investment bank. Our belief was that if they could turn that around, if they could fix that, the other 3 businesses, then the light would shine on the quality of the other 3 businesses. With a situation like a BNP, we don't have any need for a turnaround in any of their businesses. This has been historically extremely well-run company, a very good culture of risk, very good at growing. I think book value per share over the last 10 years has grown at over 7 or 8% per year. And today the company trades at just 2/3 book value. And like I said, it yields when you add in the stock buyback, it yields well into the double digits. So you have to be careful and hope that they can fix something. Now, we finally sold out of Credit Suisse, started selling it at the end of 2022, because when they released their plan to restructure the investment bank, we thought it was an extremely faulty plan. So we thought, okay, after all this time, after all this hope, they're not going to be able to fix this. And by the way, the problems at the investment bank, as we know, by the end of 2022, we're finally starting to drip into those other strong divisions. David. So this is one of the lessons. If there's a bad division, it might be bad for a reason, and sometimes you just have to assume it's irreparable.
Was it a one-off? And this is something that we keep kind of focusing on. Or do you see other issues, specific concerns in other banks, whether it's in Europe or the U.S., that haven't been fully identified?
Well, was it a one-off? It was a one-off, I believe, in the greater scheme of the European banking sector. But like any company in any region, they will run into problems. Silicon Valley Bank, I would almost argue, was a one-off. because they were so irresponsible on duration matching. It wasn't a credit quality issue. It was this duration matching with assets and liabilities. They were so irresponsible. But many banks aren't so irresponsible. So you can't, I never thought it was systematic. I do believe it was more of a one-off in the Silicon Valley Bank and the other regionals who got caught up with the same lack of risk control. Same thing in Europe. There's a company like Intesa, BNP, Allianz, these are Lloyd's. These are the financials we have that have never had major quality, compliance, risk issues. And this is what one has to look for, is the culture of risk control. Because in banks, this is number one. Risk is number one.
David, can we just finish by talking about your approach to investing? It was interesting. We caught up with Jim Zauter of Apollo in the previous hour. I'm not sure if you saw that conversation, but we were talking about passive investing over the last 10 years, just the explosion of it and the bigger getting even bigger, with money just sort of indiscriminately going into equity markets and going into the Magnificent Seven, like they have done over the last 12 months or so. David, how would you frame things? I'd like your opinion on it. Do you see passive investing as the enemy to the kind of thing that you do every single day? What use is it if you find a name that looks great on paper, but nobody else notices and the money never comes?
Passive investing is an active investor's friend. And I say this because the weight of money going into passive investing means that money is just being invested in businesses, in essence, because they are there. This creates inefficient pricing of assets. Now, in the short term, and maybe even the medium term, you listened to David Einhorn, I think, last week, great investor, but he talks about the challenges competing against these people. Because the weight of money moves into this, and the stocks, that market caps get bigger and bigger and bigger. I mean, it reminds me of this old idea called portfolio insurance. As the stock price goes up, you buy more of it. Well, when cars go up, you don't buy more cars. When apples go up, you don't buy more apples. So when the price of businesses goes up, it goes against economic fundamentals to buy more of them. So in the long term, this creates opportunity for active investors to exploit these market inefficiencies. We also look a bit more volatile, because if we don't look like the index, we're varying versus the index. And sometimes our clients don't like that. But I think ultimately it creates market inefficiency, which is good for the active investor. But in the short term, it certainly isn't painless for us long-only, boring, value, bottoms-up investors, because we sometimes get kind of blown away by where the weight of money is going, where we may be invested where that weight of money is coming from, which means weakness where we're invested and strength where we're not.
I appreciate your response to that. One day we can do a roundtable, David, with you and Mr. Einhorn. We'd love to do that in the future. David, thank you, sir. It's good to catch up with you. David Herro there of Harris Associates. Not the enemy, the friend. Passive investing is the friend of what David does every day.
It's sort of a matter of which stocks you're looking at, and it sort of matters what your investment thesis is. But this is basically how traders are trading now. It's around these baskets, and whether you basically use them to benefit you or not, this is sort of the way the new structure is playing out.
Without a doubt. Equity futures, by the way, we're negative by 1/3 of 1%. We are about 18 minutes away from the CPI print. More on that in just a moment. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A powerful winter storm is set to pummel the U.S. Northeast today, dumping heavy snow across the region. New York City public schools will hold classes remotely with as much as 8 inches of snow forecasted. Parts of northern New Jersey, eastern Pennsylvania, and southern New England could see as much as a foot. Hundreds of flights have been canceled into and out of the region's airports, according to FlightAware.com. A so-called fat finger trade is being blamed for a 7.1% decline by ASML shares in early European trading. Shares went into a 3-minute trading halt due to volatility. The drop for Europe's biggest tech company was its biggest on an intraday basis since October 2022. President Biden is forming a task force to address the mishandling of classified documents during presidential transitions. A special counsel report had found that Biden kept documents in his possession after he was vice president. White House officials called it a systematic issue affecting both parties. The task force will provide recommendations before the next presidential transition. And that's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on the program, we take a look at concentration risk.
Narrow leadership, even if it continues, it's not a healthy thing. It's making the S&P 500 and growth indices very, very concentrated.
That conversation up next, live from New York. This is Bloomberg. Inflation data moments away, 8:30 Eastern Time, about 14 minutes away. Going into the scores look like this. Equity futures negative, 0.33% on the S&P 500. Under surveillance this morning is concentration risk threatening the rally.
Narrow leadership, even if it continues, it's not a healthy thing. It is still, after all this time, a tale of two cities where the mega cap tech companies are really the ones beating the earnings expectations, getting richer and richer valuations, leading the market higher and higher. It's making the S&P 500 and growth indices very, very concentrated.
It's the latest this morning. Bank of America says investors are loading up on big tech. The latest fund manager survey saying, quote, investor positioning is increasingly a headwind for risk assets, with global equity allocation to the tech sector hitting the highest level since 2020. Sarah Malik of Nuveen making the case for other areas of the market, writing this. Investors with significant exposure to the Magnificent Seven may want to consider diversifying. In our view, that calls for taking advantage of the opportunities in fixed income. Sarah, I'm pleased to say, is with us around the table. Sarah, good morning to you.
Good morning.
Let's just start with the risk, or at least the perceived risk. Why is narrow concentration in the equity market necessarily a bad thing?
Well, there's been two factors that have been driving the market this year, and that's earnings and the economy. And if you look at fourth quarter earnings, they've been heavily weighted towards technology stocks. The Magnificent Seven earnings growth is about 60%, while the S&P overall earnings growth should end at about 5% up year over year. So the question is, what's the catalyst from here? Now that tech stocks are behind us with their earnings, what we're looking at going forward is higher for longer rates, less rate cuts than the market expects, a very heavy election year in 60 countries, in 77 countries with 60% of GDP going to the polls. All of that together is more headwinds for the markets when the catalyst of technology and their earnings growth is kind of behind us for now.
Your year-end call is basically where this market is right now, right?
It is, about 49.50.
You see very limited upside in public equity markets. Do you have a preference in terms of sectors at the moment beyond, say, big tech?
I think it's tough to bet against U.S. technology, but we need to be selective here. So companies such as Amazon, Alphabet, of course, the AI stocks are definitely more than hype. Those should continue to be the winners. But we think the market does need to broaden out. We are starting to warm up on real estate. Public REITs tend to do well in periods of interest rates where they're stable to cut. So that's an area that could perform well. As energy prices maybe continue to decline, material sectors that have been squeezed could perform well. And then, of course, fixed income over equities, with equity valuations at a premium to history. They're trading at about 15% above their average. Fixed income looks compelling to us. Leveraged loans, which tend to do well during periods of stable interest rates.
So what scenario leads you to an underperformance on the index level, but a broadening out, which requires ongoing growth, and really a rally in fixed income, which has to do with cuts to interest rates? Is this sort of the sort of soft landing base case that you think is going to somehow hurt some of the biggest winners?
Well, in equities, our biggest concern is two areas. It's technicals and valuations. I mentioned valuations are above average. Technicals are also in overbought territory, not only for technology stocks, but for the S&P in general. That's what mostly concerns us with some of these headwinds going forward. Now, in fixed income, with all of this cash still sitting on the sidelines, earning maybe 4 to 5%, we think you can get higher total returns in fixed income going forward. So that cash eventually moves back into the markets, into lower risk areas like fixed income, where you can reach a little bit more and get more yields on your investments.
Are you talking about longer term treasuries? Are you talking about investment grade credit? Are you talking about high yield?
We like leverage loans and high yield leverage loans, which should perform well during periods of stable interest rates. And also we like high yield, where you can get a little bit more in terms of returns in high yield, which is a much higher quality than it used to be in past economic downturns.
No market conversation is complete without a conversation about commercial real estate. So let's go there. What are the concerns around that for you? Do you see that as an issue that just hits a couple of banking names and not everybody? Doesn't become a sector market problem?
Well, if you look at New York Community Bank, commercial real estate is at a much higher percentage for them than other banks. So we don't think that that will turn into contagion like we saw last year with some of the larger banks and regional banks. And also within REITs, if we mentioned we like REITs, commercial real estate within the REIT benchmark is less than 5%. So there's areas that you can invest in within real estate to avoid it. Of course, at any time, though, you look at these banks, everything's digital. You could get a run on banks in general, but I don't think it's going to be a broad-based commercial real estate impact on these regional banks.
I wanted to finish on the consumer. 9 minutes out from the CPI report. 2 days later, we'll get retail sales in America as well. How squeezed is the American consumer? Because we've been told that repeatedly for the best part of a year, and seemingly we're still doing okay.
We'll get retail sales this week. December retail sales were very strong. I think that this week we'll see a little bit of a moderation, but consumers still spending. I think that's because of the trillions of dollars that came to the consumer during the pandemic and that era of low interest rates we had up until just through the pandemic. So the consumer hangover eventually will come, but we're not seeing any signs of it yet. With inflation, our concern is that the Fed has said they want to see broader disinflation before they start to cut rates. I think we'll see goods inflation continue to moderate in a few minutes, but it's super core inflation where we're worried that services spending, auto insurance, if that keeps going up, super core inflation is hot. That's not going to be great for the market.
Let's get a preview of that inflation number. We can do that with Michael McKee. He joined us now. Mike, the number 8 minutes away. What are you looking for?
We are looking for improvement. Of course, the month-over-month number for December was revised down to 0.2 in those revisions last week. So it'd be hard to see it going much below that on a month-over-month basis. But we are expecting the headline inflation number to come in at 2.9%, which would be the first time since 2001 that inflation on a CPI level managed to fall below 3%. We'll see continued progress, economists say, when it comes to the core rate, although it still remains fairly strongly above 3%. The issue is, of course, the Fed doesn't really look at CPI as other than an input into their discussions. They're going to focus on that PCE report we'll get later this month.
Mike, I am wondering in your conversations with Fed officials how much they're looking past this to retail sales and to more jobs data. In other words, this is considered backward looking and isn't going to give them what they're actually looking for.
Well, they are going to take this apart. The CPI is much easier to dissect in terms of the number of categories that it measures. And so they can find out if they're getting that kind of broad disinflation that they have talked about and you guys were just talking about. And so we'll look at that to see what kind of progress is still being made. But by their nature, all data are outdated. They're backward looking. The Fed just wants to see continued progress. And remember what Jay Powell said, we don't need to see better progress. We just need to see the same kind of good news.
Just more good data. Mike McKee, thank you, sir. We'll break it down with you in about 7 minutes' time. Sarah, can we just wrap it up with CPI? Where you expect inflation to come in over the next couple of months and ultimately when the Fed starts moving in a different direction?
Well, the key is going to be super core inflation. And can we start to see somewhat of a decline there? I think just looking at the number today, month over month, if it comes closer to 0.4%, that's going to be negative for the markets, higher for longer for interest rates. Markets aren't going to like that. Comes in below 0.2% month over month, I think you see a lower quality rally. People start to see perhaps rate cuts sooner. In between, I think we see more of the same of what we've seen year to date. Tech continues to lead. People stay a little bit more defensive, but generally that number will be mild. So we'll see how the markets react when we get the number.
Consumer confidence starting to pick up as well, Lisa. You do wonder what the psychological effect of CPI with a 2 handle might actually be, if it has any effect at all.
Well, it's clearly had an effect, or something had an effect, on the New York Federal Reserve survey of consumers that pointed to the lowest 3-year outlook for inflation going back to at least 2013. So sentiment is shifting. I wonder how much this is gasoline prices. I mean, really, how much this is just directly correlated with the fact that you go to the pump and you're seeing sub $3 barrel, $3 gallon oil. That is a game changer for a lot of people.
Wasn't that always the criticism of the Mitch sentiment survey, that you'd call them up and basically they'd base their views on where the price of gasoline was that week?
If you map out the University of Michigan sentiment survey with the price of gasoline, it rhymes pretty closely.
You can do great things with political parties and you, Mitch, as well.
Oh, yeah, it's great.
Sentiment.
I love playing
Depends
around
on
with that.
who is in the White House. That depends how happy you are on the economy, which is kind of ridiculous, right?
But it kind of speaks to where we're at right now.
It speaks directly to where we're at
Which is a great place that we're going to keep talking about.
And you're really excited about the year ahead as well to talk about US politics through all of 2024.
You know, we're at a pivot point on many places, and I'm very excited to delve underneath the hood with a lot of it. Truly, it's a fascinating time, irritating in some ways.
I'm convinced. Sarah Malika Nuveen just happy she didn't have to talk about it. Sarah, thank you. It's good to see you.
Thanks for having me.
Appreciate it. CPI data is coming up next. Jay Bryson, chief economist of Wells Fargo, breaking it down for you. Inflation data just around the corner. Equity futures on the S&P 500 just a little bit softer. We're down 1/3%. The data up next. Inflation data in America about 20 seconds away. The scores going into that data looks like this. On the S&P 500, negative by 1/3%. On the Nasdaq 100, down about 0.7. In the bond market, let's slice and dice that Treasury market for you. 2-year, 10-year, 30-year, 10-year, 4.1482. Yields down 3 basis points on a 2-year, 4.44. We're down 3 basis points there as well. With your economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, you can see the frown on Jay Powell's face as the good news doesn't necessarily continue. CPI on a month-over-month basis up 0.3% year over year. That puts us at 3.1%. That's down from 3.4, but it's not the 2.9% that a lot of people had hoped for. The core rate comes in at a 0.4 rise, much higher than the 0.3 anticipated. That's a fairly strong core report. Leaves core inflation at 3.9% after 3.9% the month before. No progress there. So, John, you can give the scores. I'll take a look at the breakdown here and see where the problem is.
I'll get straight to it, Mike. I'm sure you can guess where we are. We're negative on the S&P 500. We're down by 0.8%. As we often stress after economic data, the first move not always the right one, but we'll see if this one sticks. The Nasdaq 100 is negative 1.3%. Off the back of hotter than expected inflation, yields are much, much higher at the front end. They were lower. The 2-year is higher by 10 basis points through 450 and close to 460 at 457.32. Yields are up at the longer end of the curve on a 10-year by 6 basis points, 424.95 on a 10-year. You push those moves through foreign exchange, you've got a stronger dollar and a weaker euro. We are negative on that currency pair by 1/3%, 107.36. You put this data together with a strong payrolls print and decent wage growth. You put it together with a decent ISM services read and prices paid picking up, and you start to get a little bit more worried about maybe this Federal Reserve not being able to cut interest rates anytime soon. Lisa, I'd go back to that quote from Stuart Kaiser of Citi over the weekend and starting this week. Now, this CPI print has the power to toggle the storyline between soft landing and overheating. And here we are in the middle of February, and that conversation, I'm not saying it's running away with itself. I'll just say it's heating up just a little bit.
I think that that's what you see in the market. The idea of, just want to say, Earl Davis gets definitely a victory lap over at BMO Capital, where he was talking about shorting the 2-year. This sort of seems to edify that. But really, the key thing here is, if you're not seeing a broadening out, how long does the Fed have to wait? In other words, not only is this not as good data, but it kind of flies against some of the progress, which is the reason why I'm curious from Mike, honestly, John, whether we're going to see an ongoing sort of acceptance of broadening out with this data, even though it's not as good as previous data, because if it meets the threshold for Jay Powell or not.
Mike, we can all read the headline numbers. Are you seeing that broadening out? Are you seeing that disinflationary trend intact? What do you see beneath the surface?
Basically, we see some of the usual suspects here. One of the biggest reasons that we saw CPI come in stronger than anticipated was housing. Housing costs, shelter costs up 0.6% after 0.4 the prior 2 months. And the same thing is true of owner's equivalent rent. So home prices still pushing up, rent prices still pushing up the CPI. Gasoline prices, as you'd expected, went down 0.9. So that's the good news. But food prices were double what they were the month before, up 0.4 after 0.2. So food is something that consumers will notice. And of course, housing is propping up the CPI rate higher than the Fed wants to see. Many other things are down some. Apparel is up only 0.1%, while used cars and trucks were down 0.7. So we are seeing some progress being made. Used cars and trucks, down 3.4%, 0.7 decline for apparel. So we are seeing some progress in the areas that had given us problems in the past, but the big ones are still contributing to CPI.
If you just take a look at the market's response, people are ratcheting back expectations for a March rate cut, not surprisingly, now 17% chance being baked in. Mike, do you think that this is as bad for the Fed as it may seem in terms of moving in the opposite direction, or do you think that there are enough signs underneath the hood of some sort of broadening out that it gives them comfort to continue with some of the same rhetoric that we've heard from them?
I think you'll see the same rhetoric. It's not what was wanted or expected, but it isn't a reversal. We do see the inflation rates on a year-over-year basis for CPI going down. And remember that housing is a 1/3 weight in the CPI, where it is much smaller in the PCE, which the Fed follows. So I think they'll see this as progress, may be a little frustrating, but they weren't going to move in March anyway. And they'll get 3 more PCE reports before they get to the May meeting. So there's still plenty of time for this to turn around. What everybody's wondering is, when do house prices and rent prices start to go down, or do they?
Mike McKee, thank you, sir. Mike McKee breaking down the CPI report for you. Here's the headline for you. We come in just a little bit hotter than expected. Month over month, headline CPI, 0.3%. The number we were looking for was 0.2 in our survey. Excluding food and energy, we came in at 0.4. We were looking for 0.3. So that takes your headline year-over-year number to 3.1. The estimate was 2.9. The previous read was 3.4. Excluding food and energy, we come in at 3.9, bang in line with where we were last month. We were looking for 3.7. So let's push that through this equity market. Down hard by 1% on the S&P 500, negative 1.5% on the Nasdaq, and down 2 full percentage points on a small cap, the Russell, off the back of this move. Switch up the board and take a look at the bond market. 2-year yields a lot higher, a double-digit move, up 15 basis points on a 2-year through 460, 462, 61, up 11 basis points, 428, 48 on a 10-year. You push that through foreign exchange, yields up. Dollar stronger, euro weaker, euro dollar negative 0.4%, just about holding on to 107, session lows of 107.24. I think, Bramo, what Mike McKee just did there is really, really important. Does this inflation data change things for the Fed? Pause and bear in mind this. Or does it change things for this market and what it's priced coming into the year? The Fed coming into the year, the implied forecast from that dot plot, median dot, 3 cuts this year. The Fed had 3, the market was something like 6, 150 basis points of easing. We've been chipping away at that over the last 6 weeks. And now looking at where we are priced at the moment for 2024, we're down to about 100 basis points. So we were asking the question, how do we close this spread between the market and the Fed? The market's coming down to the Federal Reserve. So does this change anything this morning? I'd say it changes something for the market. I'm not sure quite yet if this changes anything for the Federal Reserve, and whether that dot plot from the end of December, if they were to do one this morning, right now after this, would change all too much. It's a great point, especially considering the fact that the Fed has been fairly consistent, albeit somewhat pivoting. The market lesson, though, is important here, which is which areas of the market are most leveraged to the idea of the Federal Reserve cutting much more aggressively than they've plotted out in their dot plot. And I'm looking right now at the Russell 2000 E-mini contracts that are down 2.4% at one point. Down hard. This has been the main obstacle to broadening out because there isn't conviction in a call that many people are backing away from. 6 rate cuts seems like too many for this market, and a lot of bets can't rally without something better being priced in. Let's get you some reaction on the street. Jay Bryson, chief economist at Wells Fargo, joins us now for more. Jay, your initial reaction to that CPI print from about 8 minutes ago?
Yeah, well, so, John, obviously it's not good news. We would have preferred to have seen something a little bit less than that. But, I'd make 2 points here. And one, Mike made this point as well. A is that, the Fed is much more focused on the PCE deflator than the CPI. Weights are different in that. They think it's a better measure of inflation. And by that measure, inflation is lower than what we've seen in the CPI. And the second point I would make is the Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision. Now, is a rate cut going to happen in March? Knowing what I know right now, probably not. But May is still a long way away. We still have a long data between now and May, and we'll see how the whole totality of the data pan out between now and then.
Well, let's talk about the totality of the data over the last 6 weeks or so, Jay. We had a pretty decent hot payrolls report. The ISM services picked up. Prices paid actually started to pick up as well. Manufacturing's really close towards getting into expansion territory. When we came into this morning, City Stuart Kaiser said the CPI number that we just got had the power to toggle the storyline between soft landing and overheating. Jay, how many data points are we away from having a bigger conversation, a little bit more of a powerful conversation about the prospect of this economy still overheating?
Well, I really think it's going to boil down to, again, getting back to the PCE deflator, that measure of inflation. In some sense, I mean, if you go back to the 1990s, right, we had, and I'm not saying that this is a Goldilocks sort of economy here, but we had very, very strong growth in the 1990s and very low inflation. At the end of the day, that's what's really mattering to the Fed right now. I'm not saying that the hard data don't matter, but what I'm saying is I think they're putting more weight today on where inflation is right now. And so, how many data points are we away from that? Well, between now and May, we're going to get 3 more prints on the PCE deflator. Come late April, if we're still running, north of 3% in the core PCE deflator, then we're not talking about the Fed cutting rates anytime soon. But, so that's kind of the way I'm looking at it in much more broader terms.
I am wondering, Jay, whether we're getting to the point of people questioning whether disinflation can continue without a greater weakening in the labor market. Right now, I'm looking at real wages coming in on an hourly basis at 1.4%, which is really one of the highest readings going back to 2021. How much does that have to shift before you start to see a little bit more of a broadening out in disinflation?
So if you look at the employment cost index, which we got out, a few weeks ago, on a quarterly basis, and then annualize that, that's only at 3.5%. If it stays at 3.5%, and we have trend productivity growth, that's consistent really with a 2% inflation rate. And, we've gotten 2 really good productivity numbers in the last 2 quarters. Now, you can't make a lot of inferences off of 2 data points, right? And I think we need to see more of that. But perhaps maybe what's going on underneath the surface, and maybe I'm grasping at straws here a little bit, is maybe productivity is a little bit faster than what we think it is. And if it is, then you can have that stronger wage growth that's consistent with the 2% inflation rate.
Jay, when do we get out of this muddle and we get to something other than just people on both sides saying we're either heading toward overheating or we're going to head towards some sort of downturn? What's the threshold of understanding where this economy is in the post-pandemic reality?
Well, at least I still think we're dealing with, not so much shocks of the pandemic, but we're still dealing with a lot of uncertainty as it relates to, the geopolitical situation right now. And when do we get out of this muddle? I mean, I wish I could tell you that. It's going to be quite some while, because I just think the underlying structural economy, whether it's productivity or things of that nature, with labor force growth, there's still a lot of volatility going on in that, and I think we're going to have a muddled picture for a while yet.
When you look at the balance of risks, do you think the market is accurately pricing in the risk of either overheating or some sort of more significant deceleration in the economy?
Well, so I'm not a stock market strategist, and so I'm not going to opine on the stock market. But it just seems that we came into the year with everyone expecting a soft landing, and it just seems like, in some sense, the expectation of the economy, whether that's priced into markets or not, again, I don't know, but the expectation of the economy right now seems to be for very, very good news. And if you don't get good news like today, that's going to upset that narrative, at least for some period of time.
Hey, Jay, good to hear from you. Jay Bryson there of Wells Fargo. The more I think about it, Lisa, the more I think just if you sat down with a Fed official right now, they'd probably turn around and say, I told you so. This is why we want to wait. This is why we want to wait.
This is why we're wanting to be patient. We have the leeway to be patient. And guess what? We are going to see surprises like this. We have a lot of data to look at, but we're not probably going to go in March. They can basically reiterate what they said already.
Which is basically what they've said repeatedly over the last few months. If you are just tuning in, let me wrap it up for you. So inflation data came out about 13 minutes ago, came in just a little bit hotter than expected, only 10 basis points hotter. But as you know, on Wall Street, that can be a big deal. 0.3% month over month was the headline figure. We were looking for 0.2. Excluding food and energy, month over month, we came in at 0.4. We were looking for 0.3. Year over year, hopeful that maybe we'd get a two-handle. You don't get one. 3.1% against an estimate of 2.9. Excluding food and energy, we stay at 3.9%. We were looking for 3.7. Equities, near session lows. We're down more than 1% on the S&P 500, down by about 1.6% on the Nasdaq. Lisa, you talked about a Russell, the small caps, down by 2.4% early this morning.
That highlights really how they're more leveraged to the potential for rate cuts than other asset classes, and is frankly the reason why we haven't seen a broadening out, because until you see the whites of the rate cuts eyes, people aren't going to necessarily go into some of these other more leveraged areas.
I like that, Bramo. I like that line.
Thank you.
Let's turn to the bond market. Take a look at this. Double-digit move right across the curve. The 2-year out to about the 7. The 10-year yield is higher by 9 basis points. At the moment, up 11 or 12 basis points on the 2-year. 459.22, very briefly through 460. If you go back to the middle of January 11th, the last time we got a CPI report, the 2-year closed that day at 424. We've repriced yields higher a fair bit on a 10-year from 426.91 this morning all the way back to the middle of January. We were sub 4%, closing on January 11th at 396. Now, Lisa, in that period, the equity market held up pretty well in the face of yields repricing higher off the back of decent economic data, without a real scare that maybe we'd actually have to deal with hotter inflation prints. I just wonder how this changes the story in the connection to how the data speaks to bond yields and how bond yields start to speak to equity performance.
Right now, it seems like people are looking past to some sort of a significant degree whether we get a real resurgence in inflation. But I wonder how many people are going to kind of come to this idea of Citigroup, which is 1998 on repeat. And are we going to hear more of that going forward? That's going to be a key question.
Absolutely. The number one question. Let's get you a wrap of stories elsewhere. We can do that briefly with your Bloomberg Brief and Danny Berger. Hey, Danny.
Hey, John. The U.S. Senate has approved a $95 billion in assistance for Ukraine, Israel, and Taiwan, but the legislation faces an uphill battle in the House. Senators sat for an all-night session to debate the bill, passing it 70-29 earlier this morning. Republican leaders in the House demand that President Biden take action against undocumented border migration before passing any Ukrainian aid. Shares in JetBlue are higher pre-market. Activist investor Carl Icahn disclosed a 9.91% stake. Icahn is now JetBlue's third largest shareholder behind BlackRock and Vanguard. The stock fell 30% in the last year. Federal court struck down an alliance with American Airlines in a planned takeover of Spirit Airlines on antitrust concerns. Icahn says he's had talks with management about a board seat. And shares of Manchester United climbing today after billionaire Jim Ratcliffe said he'd extend his offer to buy a 25% stake in the club, pushing the deadline to Friday. In December, Ratcliffe said he would purchase the stake by allowing investors to swap 1/4 of their Class A holdings for $33 per share. That's well above the market price. And that's your Bloomberg Brief. John.
Danny, thank you. Much more on that hotter than expected inflation read. Up next, passing through inflation data.
It's not good news. We would have preferred to have seen something a little bit less than that. The Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision.
That conversation up next with David Kelly of JP Morgan Asset Management. Live from New York City, under surveillance this morning, inflation data coming in hot.
It's not good news. We would have preferred to have seen something a little bit less than that. The Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision.
Here's the latest this morning. Your equity market's negative 1.2% on the S&P 500. Yields are higher by almost 9 basis points on a 10-year, 426.72. And this dollar is stronger. With us around the table is David Kelly, Chief Global Strategist at JP Morgan Asset Management. David, good morning to you.
Glad to be here.
Inflation data 20 minutes ago. So the Federal Reserve said we need more good data, not better, just more good data. Was this good data or bad data?
Well, not the way they look at it. I mean, they're so determined to get inflation down to 2% as fast as possible. But from my perspective, all it says is, okay, the economy is cooling. It's just cooling more slowly. There are certain aspects of this report which push the numbers higher. But overall, as this year goes on, we think the economy is going to grow more slowly. We think inflation is going to come down on a year-over-year basis. And, we've got 3.7% unemployment, 3.1% inflation. Now those two numbers together, they used to call that the misery index, but a misery index at 6.8 is not actually that miserable. So we should enjoy this. This is not bad. It's just cooling more slowly.
I'm not sure how many people are enjoying it this morning, but we can get into that in a moment. The dot plot implied maybe 3 cuts this year at the Federal Reserve. The market was closer to 6 to start the year. Do you think this is a bigger game changer for the market than it is, say, the Federal Reserve?
Well, I think people were always misinterpreting what the market was saying, because what the market was saying was really a weighted average of 2 scenarios. One where you don't have a recession in which the Fed can do these three rate cuts, or 2, you have a recession, they have to cut 300 basis points. And and what's happened is these data that we've had early in 2024 have really pushed the possibility of a 2024 recession. That possibility has been getting smaller and smaller. And so I do expect we're going to see a reaction in the market to that. The market may still have more than 3 rate cuts this year, and we're still thinking we'll avoid recession, so 3 rate cuts is what we get.
It's a fascinating way of putting it. I like the way that you're talking about the 2 poles and how this really is sort of a Goldilocks or at least strength kind of situation. What's your investment response to this, given the fact that the market has been perhaps more aggressively pricing a downside risk that's now getting pushed out?
Well, yeah, it does mean that you buy bonds for income and diversification. You do not buy bonds for capital gains. A whole generation of investors got the idea you buy a bond fund, you make a capital gain. And no, you don't. There's nothing wrong with 4.25% on a 10-year treasury, given an inflation rate which is slowly coming down to 2%. So we don't expect much of a capital gain there. We wouldn't necessarily be overweight fixed income. These look like reasonable levels. For the equity market, it's still, I think that the important thing is the scenario is continuing. This soft landing is continuing. There's lots and lots more runway. We don't run out of runway here. So we can just keep on slowing inflation down, keeping the economy growing. For as long as that happens, I think that helps people, helps move money still into the market. And the market, PE ratios don't stop at the limits of prudence. They stop at the limits of exuberance. And this market is getting expensive, but it doesn't mean the party's over now.
I guess I wonder if this is such good news for the economy, why Russell 2000 stocks aren't performing better, why they are performing worse in the face of this data and the suggestion that the Fed isn't going to cut rates more aggressively.
It may be a timing thing, because the mantra everybody has heard is when you buy small caps, in a recession. When's the recession? Oh, not for a while yet. So you got that. So the timing doesn't sound right. And then also, you've got a lot of regional banks in the small cap arena. They're getting hurt. You've got a lot of unprofitable companies. And the market cap of the top 10 stocks is enormous. But, their share of earnings is also pretty high. It does seem like money is all floating to the top in terms of market cap here. And that's not terribly helpful for small caps.
I wanted to spend the few minutes we had left with you going through your thinking and your framework for the economy, because I do think it's quite original. It's different to what we hear from a lot of economists on Wall Street. You put less emphasis on the Federal Reserve, just in terms of the economy going through this process of self-healing, readjusting and bringing inflation down. Do you think we talk about the Federal Reserve too much with regards to inflation?
Yes. I think the Federal Reserve has got a very big impact on financial markets and a very small impact on the economy, actually. The Fed will be celebrating, we managed to bring inflation down from 9% to 3%. But did they? The only mechanism by which they could have done that was to reduce aggregate demand. But we saw GDP growth of 4.9% in the third quarter, 3.3% in the fourth quarter. There is not the slightest scintilla evidence that the Federal Reserve has actually succeeded in slowing down the economy. If it didn't slow down the economy, it can't take credit for lower inflation. The economy did that itself.
And you expect us to get back to 2% with that process just continuing?
Yeah, we do have some technical. We've still got auto insurance up 20.6% year over year. And we know that new car prices have stopped rising. We know that auto repair costs are rising much more slowly. This thing's got to crack. It's taking its time, but it's got to crack. And also with shelter inflation, we know that rents being negotiated at the point of rental aren't going up that fast. So we know that's going to crack. So these two technical factors, if you look at auto insurance and shelter, they're 80% of the year-over-year increase in CPI.
Yeah.
They're going to come down, and that means that from a technical perspective, you can get down to 2 even if the rest of inflation is kind of sticky.
This begs the question, if they really only influence financial conditions and they're not influencing the direction of inflation, how on earth should one on the Federal Reserve Committee right now set interest rates? What should they set them for?
At a normal level, which will not cause financial market booms and busts, because what they've done is they've caused tremendous distortion in financial assets, in real estate, by pushing rates way too low for way too long and now jacking them up and leaving a whole generation of Americans unable to buy a house. So stop it already. Get back to a normal level. Practice your golf game. You don't need to do all this stuff and just wait for the next financial crisis, or just when you're actually needed, not to micromanage the economy.
You mean less speeches and more golf, maybe?
I think the economy would do better.
David Kelly. Thank you. David Kelly of JP Morgan Asset Management. CPI coming in a little hotter than expected. Equities down by 1.2%. Bond yields are higher. Tomorrow, this conversation will continue. Russ Kostrick of BlackRock, Sarah Wolf of Morgan Stanley, Deepak Puri of Deutsche Bank, and David Rubenstein of the Carlyle Group. That and a whole lot more. From New York City, for our audience worldwide, and for our audience in the tri-state area, stay safe as the snowfall picks up, Bramo, and the kids enjoy a snow day.
Actually, you know what? They really are, because there are technical difficulties. Yes.